of our markets team, suggesting that maybe the focus has shifted from jobs to wages, that's where the importance is when we're thinking about the Fed's next step.
Oh, I think that is absolutely right. But I think, you know, to your point about more volatility in the treasury market and more widely in yields, this is what's going to happen if you're going to move away from forward guidance to saying data dependency, because every data point matters more than the last one. And you know, I think, so yes, absolutely, CPI, wages, everything that tells us about inflation and about the stability of the jobs market is going to be really important. We saw last week, or we saw earlier this week, that people were focused more on the PMIs than they were on the beige book, and I think that's purely just because it's much more focused on those on wages and so on. It gives you those kind of elements as well.
Okay, yeah, certainly it was the wage story out of yesterday's claims data that seemed to move the market. To your point, Tom, let's look at the natural gas price then. I flagged it a couple of times this morning, but jumping once again this morning in Europe, up by 5% on the European benchmark, 7 on the UK benchmark, and this all links back to a couple of installations in Australia, doesn't it?
Yeah, and I mean, natural gas is a very volatile market by its nature, and it is up on this latest headlines and the strikes that we have in Australia. I would caution and say that, you know, Europe's natural gas tanks are virtually full going into winter. This is going to become an issue if it drags on late into the winter. I would be much more focused on, say, the February contract later in the winter to see whether, you know, Europe supplies are being replenished, or maybe on Asian contracts.
Does Apple look oversold, at least on a tactical basis, to you, Eddie? Is that a sentiment that's starting to come through now, given the selling pressure that's come through in the last 2 days?
Yeah, look, Apple has come off a lot, and people are starting to realize the geopolitical risks that you know have focused on this company. But I think it is justifiable, because I do think that Apple remains a company that is uniquely exposed to China manufacturing, right? But also to China demand, because it sells a lot of its high-end mobile phones and so on into that market. And if consumers there start to sour on Apple, that's going to be a worry. And I think it's going to be more important as we get towards the US elections.
And thinking about the trading day that we've seen through Asia already, very disrupted then, Eddie, by the amount of rain that has fallen in Hong Kong. I mean, just to reiterate what we said in our headlines, you have to go back to the 1880s to find a time where we saw this much rain fall in a short period. So quite incredible, this weather event taking place there. And as our colleague Mark Cudmore was saying, it makes actually interpreting some of the data. Of course, the sort of humanity of this story is front and foremost, but when it comes to what this is doing to a market that had to close as a result of this, it's difficult to actually read some of the signals through the Asia session.
Yeah, absolutely. And these extreme weather events are becoming more common. Now, you know, I think for me, this story captured just that financial markets need to wake up to the fact that they too are going to be impacted by extreme weather. So if you see, you know, it's not just going to be flooding in, you know, that's going to bother normal people. It's going to impact markets in a very direct way, not just through disruption, of course, but also through pricing.
Yeah, it's a really good point. It really crystallizes that impact, doesn't it? The events happening and unfolding in Hong Kong. Eddie van der Walt, of course, from our Markets Live team. Thank you. Let's get a check then on some of the individual stocks on the move and check back in with Joe Easton. Joe.
So Berkeley Group is pretty volatile in the early start of trading in London. The statement was quite difficult to read. They do reiterate the guidance, but also warning of some big drops in some of the valuations on the properties that they own. So it's now up 0.3%, but was down around 0.5% just a moment ago. Then over in Italy, we've got Saipem, the big energy company, announcing an order of more than 800 million euros. It's a big deal for that company. That broke this morning on the terminal, so up almost 3% for that one. In terms of other UK earnings stories, two stocks going very different ways. We've got Computer Center jumping. This is enterprise software, seems to be a strong spot. They're not showing any signs of customers and companies cutting back on enterprise software. So that one up 6%. But Petershill, this is the asset management firm, down 1.5%. Interestingly, there was a note from RBC today saying that asset managers are seeing a decline due to the risk-off sentiment in markets, and that's something that Petershill reports this morning in their earnings, down 1.5% at the moment. In terms of the other sector moves that we had in focus, just taking a look at some of the luxury stocks rebounding. It's been a pretty bad week for those shares. On Wednesday, some of those stocks were down by almost 5%. LVMH had a bad run. There is a note out from HSBC today saying that Chinese spending in Europe is still only 40% of what it was pre-pandemic, so a long way to come back up, even though it has recovered in the Asia region, according to them. So they're getting a bit of a rebound. Then the Apple suppliers, mixed picture at the moment. AMS Osram, a big supplier to Apple. That one is slipping around 0.4% with that big sell-off that we're seeing in Apple shares in New York over the past couple of days. AMS, the machinery chip maker, that one is ticking higher at the moment, not seeing too much of an impact on that one. And in terms of the ratings changes today, we had Volkswagen in the stocks to watch, that one rising as Berenberg upgrades the stock to buy. As we said earlier, they say that stock is too cheap following the exposure to China that's seen that stock selling off. And Porsche slips a bit with Berenberg cutting that one to hold. They change their preferences on those ones. UBS actually gets a price target upgrade over at Vontobel. They say that the CEO will manage to cut costs following the Credit Suisse acquisition, but not reacting to that one at the moment, down 0.5%. One stock that is moving in line with the rating is Next. SocGen upgrades that one to buy, given the weakness that's weighed on that in terms of the UK retail uncertainty. There's a bit of a bellwether for the consumer stocks. So that one upgraded at SocGen and up 2% in London.
Thanks very much, Joe. Joe from our equities team with the latest on some of those movers. Let's take a look at some of the events that we're following for you today then. In terms of market moving potential, at 9:30 a.m. UK time, we get an update from the UN's food price index. Tom was flagging the rice price as being crucial in that conversation. Also on the agenda today, Canadian unemployment data is going to hit. That comes out at 1:30 p.m. UK time. There's been a real focus on the weakness of Canadian data and the pause in rates. We've also got our eyes on Asia for a busy weekend in that region. On Saturday, we get the August print of CPI and PPI out of China. How much of that deflationary impulse is going to continue to be transmitted around the world? And that's at 2:30 a.m. UK time. Lastly, a big weekend in India, of course. World leaders arriving in New Delhi for the G20 summit. Really interesting lines coming out from Janet Yellen earlier on today on that subject then. So I'm downplaying the impact that weakness in Chinese growth will have on the US economy. A really interesting one to pick up on with economists who have varying views, actually.
It's a live debate, and our own Anna Wong, who's our chief US economist, who used to be at the Fed and put out some research when she was at the Fed, looking at potentially a bigger impact in the light of a prospective significant downturn from China. So that impact, or at least the debate around that impact, continues, and Janet Yellen weighing in with her views, at least, of course. Coming up, the ECB may raise interest rates one last time to tame inflation, though economists are evenly split on whether it will happen next week. We discuss that next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today. We are 13, almost 14 minutes into the European trading day. Briefly having a look at equities before we move on to gilts here in the UK. European stocks up 0.2%. But in the debt markets, it has been some interesting moves across these debt markets. But gilts as well. A significant move yesterday into UK government debt, particularly at the front end. In fact, in the last 3 sessions, the 2-year yield has come in by about 18 basis points. Yesterday, the catalyst for money moving into UK gilts was this BOE inflation expectations survey, which fell to its lowest level in 2 years, and a reassessment as well by investors, of course, on the back of comments from the Bank of England Governor Andrew Bailey and the chief economist in the last few days, Hugh Pill, around the prospect of maybe getting closer to a pause. And in the session today, you're seeing yields coming in again at the front end, down 4 basis points, just holding above the 5% level on the 2-year. Let's stay on this topic then and bring in Caroline Simmons, UK Chief Investment Officer at UBS. Caroline, we were talking in the break about how the markets are coming around to your view on the BOE and on inflation. Just unpack that for us.
Yeah, that's right. I mean, broadly speaking, we're roughly about 1%, or it's probably about 80 basis points now below where the market is in terms of our views across the curve. We do think that inflation will continue to fall, albeit more slowly than in other regions. And these expectations, you know, they catch up to the reality of what has been happening. And inflation has been starting to move down. And as we go through into the fourth quarter, we'll see another step down as well. And so that's leading to the adjustments in the yield curve that one would expect. With that realization that inflation isn't going to stay high forever.
Yeah, absolutely. Just to underline that report that Tom was talking about there, the finding in that survey of expectations around inflation is that inflation is expected to increase by 4.4% over the coming 12 months. That's the least since November 2021, and it's quite substantially down on the July figure, which was 5.5%. So those expectations are dropping. How does that and the sort of rates headache that is being stored up for the UK economy, how does it fit into your asset allocation then, Caroline, at this point? Because everybody can see that homeowners are going to be up against it, those who come off fixed rates, and at some point that's going to bite. What does that do to asset allocation, though, when you're looking at the UK?
Yeah, I mean, it just provides a preference for fixed income over equities, essentially. You know, the yields on the fixed income are now attractive. If you look at the relative valuations, equities don't look as attractive, particularly, say, in the US market, where the equity risk premium is now at or below, in fact, its long-run average. So you want to be in the fixed income space, and you have the added sort of protection, if you like, that if growth comes in slower than people are expecting, then you'll get faster cuts in the central bank rates, and then you'll get an even better return from the fixed income. So, you know, that's how we're positioned. We think fixed income's likely to outperform, particularly on a risk-adjusted basis over the next 6 to 12 months. I just wanted to add a comment about the inflation expectations. Historically, I believe inflation expectations have always overestimated the reality of inflation by about 1% over time. So that's quite a big difference.
I mean, 4.4 minus 1 gets us not a million miles away from the target.
So
I mean, for the UK.
So let's see. Yeah.
The maths around here is
it's incredible.
Did
you like the way I did that?
I loved it, Caroline.
That was real time.
Anna, sorry, Caroline. I'll ask you a maths question now.
I'll do the maths. You can learn the names.
Yeah, please do. You stick to that. Caroline, you like fixed income. You like investment grade. What pushes you up in terms of the risk spectrum in fixed income? What do you need to see to move into high yield?
Yeah, I mean, to move into high yield, you need to have a greater clarity on where the default rates are going to peak. So, you know, we're forecasting the default rate to pick up to around 5% on the high yield space. We need more evidence that that's as high as it goes, or you need a better pricing to justify for a higher default rate. So we've got about an 7-8% yield on high yield at the moment, which is quite attractive. relative to where it was, but not enough for us to want to go, sort of full tilt onto
Which
it.
geographies are we talking about here? Because I see a lot written about the US market and high yield saying that it's really just not priced for anything like a recession. You might argue that other asset classes are not priced for a recession either, but a lot of people looking at the spreads on high yield and saying this doesn't look like an economy that is heading towards the buffers. Where do you see this dynamic most clearly?
Yeah, so I mean that's true. I don't think it is priced for a recession. So a recession is not actually in our base case. Like slowing growth down to zero, yes, full-blown recession we think is getting less likely in the US. And therefore, we're okay being neutral high yield. If you thought there was going to be a full-blown recession, you don't want to be in the high yield space. So I think it's around those growth metrics that will determine whether someone wants to go into that area or not.
Caroline, is Germany now the sick man of Europe?
Well, this is a recurring question we're going to see now. Low growth, high inflation. Many countries are going to face this and are facing this. And the question is, what influence is our external factors going to have? Things like, China growth, which is particularly important for Germany, for example. And then how long does the low growth last? Because, if we're just talking sort of 2 quarters of low growth and then we get a gradual sort of increase again, then that's okay. The momentum is recovering and it's not really a stagflation environment. But if we end up with an area where that growth doesn't really recover, inflation comes down, but maybe not all the way back to target, then it's a more difficult environment to be in.
And very well documented, the links between the Chinese economy and Germany, of course. Much talked about and perhaps less obvious links between China and the United States in terms of the economic impact. Janet Yellen over at the G20 in India saying she sees Chinese growth slowing over time, which I'm sure many would see as sensible, but saying that she doesn't see a very significant direct impact on the United States. I suppose it's a question of degree and whether you're talking about something at the margins or not. I mean, what is your assessment of how vulnerable the US economy is going to be to what's going on in China at this point?
Yeah, so at a broad level, if you look at the sort of imports and exports, they're not as meaningful as they are for, say, Europe. So we don't think that the current slowdown in China is enough to push the US into a recession. But obviously, you're going to get certain areas of tension or importance, around the tech space, around certain commodities, where obviously the impact is more meaningful. But as an aggregate to the overall GDP, not as important as it is for Europe.
Okay, Caroline, thanks so much for your time this morning. Caroline Simmons, UK Chief Investment Officer at UBS. Thanks to Caroline for joining us. Coming up on the programme, latest data shows the cost of renting a room in London has surpassed £1,000 a month. We'll discuss that next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupied areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
People
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Welcome back to Bloomberg Markets today. Now, the cost of renting a room in London has topped £1,000 a month for the first time. That is according to data from the website Spare Room. Joining us now with this story, Bloomberg's Eamon Farhat, who's been looking at the details here. Good to speak to you, Eamon, on this story. So who does this affect then? And what's been driving this big increase in rental costs, rental prices that's been much talked about in the UK media?
Yeah, so the Spare Room platform, as you said, is room rental, so it's usually the most flexible part of the housing supply. If you want to move to London or to another city, it's the easiest way to just get a room and get on with your life, your job, your education. So it's definitely younger people, graduates, but more and more we are seeing older people renting for longer because of the high cost of housing. And the reason that the thing that's driving all of this, there are a range of factors. One of the big ones is that we have had for a long time lack of housing supply in the UK. That's kind of the long-term trend that we keep hearing. But on top of that, we've had obviously in the last year mortgage rates going up, inflation and all that, which means that landlords, buy-to-let landlords, a lot of them are selling up, their margins are being cut into, and people who would have maybe gone to the housing ladder, they're renting for longer because they can't, get that mortgage, they can't get that first property.
Do we have a view on how long this extends into the future and how London compares to other regions in the UK?
Yeah, so London's always been the most expensive region. That being said, some other parts of the UK, Manchester, Edinburgh, have actually had some slightly steeper rises. And right now, when it comes to the actual demand picture, it's looking worse outside the UK than inside the UK. So there's about 6 people per room in London, and it's a bit higher than that outside the UK. When it comes to the outlook, obviously we're getting to a point where rates could be starting to get to a peak and maybe start to come down at some point. But when you talk to people, just because mortgages will come down, rates will come down, that saving doesn't always pass on to the renter, so that inflation then becomes a bit embedded into the system. So, landlords don't always pass on their savings when it comes to mortgages.
Right, so we're watching these rental prices go higher. It's really interesting from the sales side of things as well to watch what's going on with the buy-to-let part of the market, because during the GFC, and we saw the housing market under stress as a result of that, there weren't so many buy-to-let landlords who were getting out of the market then. So this is quite a new dynamic, and as you say, it's having an impact on not just the sales side of things, but also on the rental side.
Yeah, no, definitely. I think there's also been some new regulation that came in 2020 that means that landlords can't recoup the cost of their interest payments, which is why some of them are actually moving to shorter-term lets, to Airbnbs. Lots of people in London right now are getting kicked out. Their flats are becoming these shorter-term lets because it's more profitable and they can recoup those tax benefits. And yeah, at the same time, this is obviously quite a small, narrow part of the market. This is room rentals, but it does represent, as I said, the most flexible part of the supply. It's, usually the easiest way to kind of start off, whether it's a job and all that. And it is holding back businesses who are looking for labor. There's lots of labor shortages, and that sometimes comes from the fact there's a lack of housing.
Okay, Eamon Farhat, thank you for bringing that story to us on the pain in that part of the rental market. £1,000 on average just for a single room in London. Coming up, we're going to dig into the rise of artificial intelligence in the construction industry. The co-founder and CEO of Nplan joins us to discuss how his company, backed by Google Ventures, is using AI to better forecast budgets and timelines. That interview is next. This is Bloomberg.
not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power, the
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
Trading. Apple continues to weigh on the Nasdaq, the tech giant losing nearly $200 billion since Beijing decided to curb iPhone use. Meanwhile, chip sector concerns spike amid a Washington probe of chips used in Huawei's new smartphone. Plus, Goldman Sachs is reported to be moving to fire underperformers as soon as next month. So, Tom, in terms of the European session, we're trying to move on from that Apple story, really, aren't we? So that was definitely what's been dominating, certainly the Asia session. But here into Europe, we've got modest gains, and US futures looking a little brighter.
I like your emphasis on trying, because that's exactly what's happening. There isn't conviction across these equity markets. In fact, the gains that we saw at the start of the session has started to fade. Yes, still upside, but very modest, as you were saying, Anna. Just a gain of 0.1% across the European benchmark. The DAX is still above that 15,700 level. But again, this all comes on the back of 7 straight days of losses for European equities. You're posting less than 0.1% of a gain for the German index. The FTSE 100 is still below that 7,500 level at 7,448, just adding 6 points at about 0.1% in the session. Across the sectors, let's flip the board. Travel and leisure, the last time I looked, was topping the list. We continue, of course, to focus on the energy sector, given what's happening in terms of gas prices and the strikes in Australia, and then, of course, oil. And prices around oil have come off a little bit. The dollar has softened marginally, and money continues to move into sovereign debt, but at a less pronounced pace today. Yields coming in by between 1 to 2 basis points, the last time I checked, on UK gilts. Autos as a sector down 0.1%, so modest losses there across that sector. Of course, that weighing on the DAX just around the edges. Travel and leisure, there's the standout in terms of the gains, 0.7% for the travel and leisure sector. Some of the gambling companies seeing some upside in the session. Utilities gaining 0.2%. There's the energy picture then, down 0.2 as we moderate at least some expectations around where Brent goes from here. $90 a barrel or thereabouts is the level now. Basic resources down 0.2%. That was the leading loss maker across the sectors yesterday, and again the softness coming through from iron ore. Tech is having a fairly decent session. Expectations that maybe, from some, that maybe the sell-off around Apple has gone a little too far, given that market value being reduced by close to $200 billion. That sector currently gaining 0.4%. And the other big story for us today, of course, is what's happening in Hong Kong.
Yeah, absolutely. And interpreting some of the market moves through the Asia session, it got a little bit difficult, really. Hong Kong had to abandon trading as a result of the amount of rainfall that fell in this city in 24 hours. We're looking at live pictures of Hong Kong as the cleanup attempts get underway. We've seen flooding, extensive flooding and landslides. The heaviest rainfall since 1884, or at least since then, because that's when records began, apparently. So no trading in Hong Kong was the the state of play by the end of the trading day. It all happened with very short notice, without the usual sort of warnings you get around typhoons in a city usually usually very good at forecasting this bad weather. And of course, we've got Bloomberg Intelligence working on estimates for insurance claims now totaling $100 million. So a lot of focus on that, the level of disruption caused by that.
Well, it's interesting, isn't it? Because infrastructure is important in terms of the resiliency of infrastructure in this climate crisis that we're facing. It kind of ties into our next story and our next guest. Bloated timelines and cost blowouts often come hand in hand, of course, with large-scale construction projects. We see this time and time again. But one UK company says it can help developers reduce waste and speed up work, all thanks to AI. Enplan, which is backed by Google Ventures, uses machine learning software to forecast project outcomes. Its clients include oil giant Shell and construction firm Skanska. It's also worked on the contentious HS2 rail project here in the UK. Very pleased to say we're joined by co-founder and CEO Dev Amratia. Dev also helping to craft in 2017 the UK's AI strategy under the former Prime Minister Theresa May. Dev, thanks for coming to the studio. Let's talk about some of the use cases then of your AI platform. A lot of hype, of course, around ChatGPT. I really wanted to speak to you because I'm really interested in how your platform is actually helping materially, in a real sense, companies right now. Talk to us about the use cases.
The biggest use case we see is figuring out how long a construction project is most likely to take, what risks they have to execute these projects, and crucially, what they can do about these risks. Essentially, the problem is it's incredibly difficult to foresee how much risk you're taking onto yourself when you're building these projects, right? At the start, it's quite hard to figure all of this out, given the complexity of these projects.
So give us some case studies. You know, you talk about HS2, and in fact, in the news meeting yesterday, Anna raised the point, well, hang on, HS2 has been delayed a few times. Can you account for those delays, and can you give us some case studies as to where you've seen material impact and efficiencies created around the forecasting and the risks involved in some of these projects?
Certainly. Probably one of the one I'm most proud of to date, and there are a number of them by now, is a project in North America that's a very large oil and gas system, LNG to be specific. So you're talking about tens of billions of dollars of investment. To date, we've helped them avoid spending $180 million just by telling them, hey, in advance, that thing over there is probably not going to work out the way you think it will. So the team, using this information that our AI algorithm generated for them, are able to take corrective action before they need to spend the additional money.
Okay, that's a real life example of how it saves these projects and these contractors money. So you use this data, which has been trained on historical performance from 740,000 projects, I understand. And so when you take this to the industry and to potential clients, do you find they all want to jump on this extra information, or are they doubtful that it can tell them anything that they don't know already? I just wonder how an industry responds to this kind of new tool, because you're kind of putting a lot of faith in a bit of a black box.
Yeah. So at first, there are skeptics. You know, we've been going for 6 years now. We recently won the McRobert Prize for Engineering Excellence and Innovation, one of the most prestigious awards in innovation in the UK. But over those 6 years, we've learned how to show the forecast's legitimacy. This is a complex problem. How do you know a forecast, something in the future of time, is correct today?
Yeah,
right?
Especially when you might not be able to explain why it's correct.
Yes. So what we do is we have the most rigorous back test you can imagine, right? We pretend it's 2015 again, and we forecast 100,000 projects, right? Which is a lot of projects, a huge diversity out there. And we'll be able to tell how good, and also where we might not be very good at forecasting, right? The algorithm is actually humble in a way. It knows how to say when it doesn't know something, you know, perhaps the sector could use a bit more of, we could all use a bit more of.
You've talked about some of the cost-saving examples. There's obviously a big push and a big conversation in the UK and other places about unlocking spending for infrastructure projects and why so much cash remains on the sidelines, unwilling to be committed. Are you seeing any change there? Is there anything that you're doing that can help get that capital into some of these projects?
Yes. The mission of Enplan is to build a world no longer limited by its appetite and risk. I fundamentally believe, my entire team believes, humanity is held back because we just can't take investment decisions.
Have you had conversations with executives saying, okay, I am prepared now to commit additional capital because I have a clearer forecast?
Yes. So the example is with Kia Group. We worked with them when they were bidding for the Oxford Station redevelopment program, £65 million project with Network Rail. Kia used Enplan's forecast to increase their confidence to their client, Network Rail, that they have the ability to understand and execute on the project, right? It increases investor confidence, allowed them, they won the work, right? It's being built right now. And so, yes, certainly.
It's interesting when you make the pitch for what AI can do here. You kind of conceptually, I'm interested in the biases you want to include in the data and the ones you don't, because the advantage of using this data is it can remove the biases of the team that are working on this, I suppose, in some ways. But aren't there some biases that might be actually quite relevant, like recency bias? You know, if it recently has cost this much and taken this long, you need to know that versus a project that happened 10 years ago, which maybe is less relevant. So how do you sort of work through all of that?
Yeah. So what we can do is we figure out the algorithm understands that something that happened yesterday is the best indicator of what will happen tomorrow, and equally the further the spreads become. But the beautiful thing about the data that we're analyzing across this huge sample, it's like $1.6 trillion of capital in analysis in Enplan today, and only growing. That data is unequivocal. It's what they plan to do on the projects and what happened. No biases. You're not allowed to say there's no biases involved in reality. And bringing that forward is a very impartial way of being able to articulate to a customer what might happen to them.
Dev, you think about forecasting, think about risk, and it makes me think about the insurance industry. Talk to us about your ambitions in that space. You're quite bold in terms of what you think you can change within insurance in that sector.
Yes. So today, we forecast projects. We can do that for a single project. We've just launched a product around portfolios of projects, so we can analyze hundreds of projects simultaneously. The very next step, we're saying we're very, very good, to at least 10 times better than anyone else on the planet at forecasting projects. The next step is for us to start taking the risk. And that is code word for insurance. That means we aim to launch a product called Project Overrun Insurance. Basically, as it says on the tin can, we will be able to write the risk of an overrun, dramatic overrun, on a project into the insurance markets. Something quite challenging to bring to market today, given the cost of debt and where we are in the insurance markets. But certainly we have the data, we have the technology, and hope to bring to market soon.
Okay, that sounds like a fascinating new business line, I suppose, new industry to be going into. In terms of AI in the UK, and Tom started this conversation mentioning how you were involved in writing that a report for the UK government 5 years or so ago, I think, under a previous administration about the state of AI. The conversation seems to have moved on, both in terms of the amount that we all know about AI, the use of it, ChatGPT and the like, helping a lot, but also our fears around it, some of them existential in nature. How do you look ahead to the UK conversation around AI? Because the UK wants to lead on this, doesn't it? Especially around regulation with this conference coming up in Bletchley Park.
Yes. So firstly, I'm incredibly proud of the pace that it's moved at. Back in 2017, when we started writing the report, we never thought there would be so much advancement here in the UK. The conversation that's starting now here in the UK is a real advantage for the country to capitalize on. Taking advantage of the fact that we are the first to be thinking and talking and convening in the subject of safety is something I think is the right step. Some of the things that I think we could do more of, right, is bringing together the people that are doing it in the world, in the real world, right? There are very practical examples of organizations that are implementing safe practices. I mean, Enplan is one of them. I told you about the back tests, right? That's a way of showcasing how do you do things properly. Don't just make your way into the industry and hope to disrupt it, right? There's a good way of doing business in a way that is sustainable for the people that are consuming this huge amounts of information, all of a sudden generated by an algorithm, which is not something most human beings are very comfortable or even familiar with.
Okay. Enplan co-founder and CEO Dev Amratia, thank you very much for coming to the studio on The View around how AI is being implemented on the ground around construction, infrastructure, maybe a move into insurance at some point, and the prospects for the UK around AI safety. Thank you.
Yeah, coming up on the programme then, we'll get to another sector. First, fake jet engine parts, now fake employees. A supplier of bogus aviation components at the centre of a European investigation may have fabricated more than just plane parts. Bloomberg's been running with this story for a week or so now. We'll bring you the latest developments. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back. This is Markets Today. European stocks then bouncing a little this morning, trying to put the woes of Apple behind us as a driver of international sentiment for risk assets. US futures point a little higher, up by 0.2% on Nasdaq futures after a couple of days of Apple negativity. Let's turn to the aviation sector, where a bogus supplier of jet engine parts being investigated by regulators may have faked employees too. A deeper dive into the firm, this is AOG Technics, revealed that the fabrication not only concerned components, but extended to other aspects of the company as well. Let's get further into this fascinating story with Sid Phillip from Bloomberg's Global Aviation team. Sid, the latest twists and turns on this are quite fascinating. So what do we know about AOG? It is actually a little-known company in the UK at the heart of this episode.
Absolutely. So AOG is a little company that we hadn't actually heard of until we actually started working on this story about fake parts. And essentially, the crux of it is that they supplied parts with fabricated certification. And in the aviation industry, certification is everything. Everything in the aviation industry, from every single bolt to aircraft engines, is certified. And that's because safety is paramount. And when you sort of upend that with fake certification, that sort of creates lots of problems.
Sid, where are the regulators? Where is law enforcement on this? Why aren't they raiding the offices of this company? Why aren't they dragging people in front of regulators for questioning, or lawmakers, or at least law officials, the police? Why aren't they being grilled about what's going on? And how significant is this?
So regulators are looking into this company. I mean, they have issued something called a suspected unknown parts notice. And essentially that notice basically tells operators, maintenance shops and everything that if you have parts from AOG directly or indirectly, pull them off aircraft now. And essentially, we have looked into this company, and some of the parts that they've been sort of accused of creating fake documents for include engine turbine blades, and that's what the regulator said. So essentially, it's quite a serious issue, but although the extent of it is quite unknown at the moment as to how many parts, how many aircraft, what the sort of scale of AOG's supply was actually.
Yeah, so that's why getting a handle on size and scope of the impact of this is quite difficult. And obviously, nobody wants to create panic unnecessarily, but also the sector very focused on safety. So faking the certificates that go with these parts has been the start of this story, I suppose, Sid. But then moving on to something more recent, you've discovered that it actually has completely fake employees, this
Absolutely.
business.
So we looked into the company, and we sort of looked at their profile on LinkedIn, and we looked at the company employees who claim to work on LinkedIn, and we found that every single employee that we saw with AOG Technics in their bio, the image is a stock image. I mean, they're not the people who claim to be, and they haven't responded. And so it really does sort of show that this was quite an elaborate fabrication, with the company not really being clear about who people are, what people do, and who they really are in terms of employees and everything else.
Okay, Sid, really, really important investigation that continues, of course, led by Sid and the team focused on aviation here. Another aviation angle, Sid, just very briefly, have you seen the pictures of Michael O'Leary, the CEO of Ryanair, being pied outside the European Commission?
He said it was delicious. Carried on with his press briefing.
Although he said that the cream in Ireland is better, apparently. So.
Okay.
He's never short of a line, is
Dealt with in true Michael O'Leary style, I feel.
Okay, coming up, stocks rebound from recent losses as traders focus on those dovish comments from Fed officials. We're going to look at that and much more next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Markets Day, 52 minutes into your European trading day. Gains of just 0.3% across European stocks, or thereabouts, a little under actually, 0.2%. US futures pointing up. Nasdaq futures to gains of around 0.2% as Apple continues to be a question mark for those invested in the tech space. Let's talk about what's happening in these markets then. A bit more of a deep dive and bring in Noor Ali from our M Live team. Noor, where is your focus today?
I want to say LNG because everyone's looking at LNG, but I'm only going to say LNG because it doesn't really matter in the grand scheme of things. If you look at the volatility of LNG prices today in Europe, we're seeing it on the rise as well. But if you compare it to the volatility that we've seen last year with the Russia-led invasion, it's nowhere near that. So I wouldn't be as concerned just yet on European prices, particularly as the strikes now begin in Australia.
Yeah, okay, so everyone does focus on it because the percentages look big, don't they? But your point is valid. I mean, 34 euros a megawatt hour, it's nothing like, so the volatility is not the same as last year, but also the pricing. I mean, we got up to 290 or so euros a megawatt hour, so we're not talking about the same magnitude of moves or level of volatility. So that's the Australia story, though. Still, worth watching, has an impact on prices globally, 7% of production from these places, from these particular installations. Let's talk about tech then, because this is an area of focus. I mean, Apple and the NVIDIA story, or, well, Apple in particular, grabbing the market's attention over the last couple of days. The geopolitical threats on the demand and on the supply side, very clear for investors to see for such a highly valued business.
Yeah, absolutely. And that's the concern. That's the geopolitical angle really playing up here. And, you know, China is a big market for Apple, a lot of tech companies as well. We're thinking now about the semiconductor industry as well, NVIDIA, part of that as well, being locked into that as well. And I think here the question, if you want to tie it to the macroeconomic backdrop here, real yields have been rising. And we know historically that the NASDAQ 100 doesn't really perform well when, you know, when those real yields rising. So is this the tide turning for Apple and tech stocks? I don't know, not yet, right? Because the momentum has been something that's been quite strong for stocks this year. You know, they've come off a really bad year in 2022, and they're really rising this year. So I think they've been a lot more resilient than we give them credit, and we'll see.
Yeah, there's certainly going to be some investors sitting out there thinking this dip in Apple is a clear buying opportunity, at least in the short to medium term. When it comes to China, really interesting in terms of the decision by the PBOC to soften the fix today. Are they just moving barriers out of the way for the yuan to move lower? They realize that actually this is what this economy needs, is a softer currency.
Perhaps, right? The biggest issue that China has today is wheeling in that new money from foreigners, regaining that investor confidence after years of crackdown on its tech industry, on its property industry, right? And we're seeing a lot of struggles, and the economy is not really picking up at the pace that China's looking to. Now, China has not also given these broad-based stimulus efforts. They've been a lot more targeted, and they've been a lot more specific. And now when they're doing this move, is it a signal for traders to think, you know, this is perhaps a bit more of a line in the sand that they're willing to move? And what does that mean for sentiment? I think this plays out now into the next week, particularly with the Fed's quiet period. We're going to see a lot of those themes play out in the markets.
And one of the things we're focused on very closely is wages. And we saw this yesterday in markets when we got the data out on claims. It was the wages side of things that seemed to grab the market's attention. And we've seen some interesting anecdotal stories around Walmart and what they're doing on wages. Wage growth for job switchers, that's the theme that was dominating in the pandemic, and that seems to now be disappearing as well. So it's an interesting dynamic to watch.
Yeah, 100%, right? I mean, the wages is a massive part of the inflation story today. And I think for the most part, if you want to strip out everything else, I think wages remains to be one of those lagging effects. Now, I know that we've had, the Bank of England's MPC member, dismiss the lagging aspect of it, but it is still very much lagging. And it's something that I think you would see down the line, particularly as we look at strikes and we look at people really negotiating and trying to up their payings. And now the thing here that we've had data that came out of the Beige Book that showed the labor market slowing, many businesses also expecting wage increases to ease broadly as well. I think that really ties to the inflation story here, and it helps the Fed now consider a pause more realistically or perhaps an end to its cycle.
Okay, so certainly part of the wage story that we're watching very closely. Noor, thanks very much. Noor Al-Ali from our Markets Live team. Remember, you can get up-to-date analysis and insight from Noor and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. Have a great weekend when we get there, everybody. That's it for Markets today. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. In insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European gas prices jump after workers at key Chevron sites in Australia begin long-awaited strikes in a dispute that's roiled global energy markets. Apple continues to weigh on the NASDAQ, the tech giant losing nearly $200 billion since Beijing decided to curb iPhone use. Well, we'll bring you the pre-market moves in just a moment. Plus, Goldman Sachs reported to be moving to fire underperformers as soon as next month. Now let's take a look at the European market map. A lot of the focus, of course, on dollar, the biggest story this week, the dollar snapping some of its winning streak. Stock markets rebounding from some of the recent losses. Traders really focusing on dovish comments that we had from Federal Reserve officials. If you look at the FTSE, gaining 0.1%, the DAX also a little bit higher, 0.2% higher. But it all has to do with LNG. This is really the big story today. So if you look at natural gas, and we'll get onto that in just a second. So energy markets this morning really taking center stage. Workers at Chevron's sites in Australia started long-awaited strikes. This is year to date. And you can see it's still down a touch year to date, although today at the open, we saw a 10% increase. And then we look at NASDAQ. It was one of our top stories, the NASDAQ 100 closing, of course, below the 50-day moving average. I think we have that chart. If we don't have that chart, we'll bring it to you very shortly. This all has to do with price to perfection for some of the tech stocks. Apple shares, in fact, dropped almost 3% yesterday, with its two-day slide actually wiping around $190 billion from its market value. This is amid concern about iPhone sales in China. So let's get straight to Bloomberg's Alex Webb with the very latest. So Alex, first of all, how important is the China market to Apple's bottom line?
It is Apple's second biggest market after the US. It's about 20% of total sales, so it clearly is significant. I think we need to put, nonetheless, these bans in a little bit of context. What has happened is that, according to Bloomberg sources, China is cracking down on the use of iPhones in state-owned enterprises. So that's not just clearly government ministries, but companies such as PetroChina that are state-controlled. There's some estimates out there from analysts that represents, actually a very small percentage of Apple's total sales in China. The bigger issue, therefore, is whether it speaks to the mood music. Is there a rise in sort of Chinese nationalism where just ordinary people are more inclined to buy Chinese-made products rather than those from elsewhere? In the past, those sort of movements have chipped away at Apple's sales locally. That is perhaps what the bigger concern is right now.
The US says it's now investigating the made-in-China Huawei chip. What more do we know, Alex?
So Huawei has released this phone called the Huawei Mate 90 Pro, and it's like it uses a chip made on the sub-7 or on the 7-nanometer process, which is very, 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 very small and very close to actually what Apple is able to do through its contract manufacturer TSMC. it isn't, nonetheless, the bleeding edge. It is about one generation, depending on what Apple announces next week with its new iPhone, maybe 2 generations behind. It is nonetheless a lot better than what everyone had expected. The US is now carrying out an investigation to see how they've done this and, crucially, whether any sanctions have been broken in the course of its manufacture.
Alex, thank you so much. Alex Webb there with all of our terrific roundup, of course, some of the tech news that we saw overnight. Now, global gas prices jumping on the news at LNG workers at key Chevron sites in Australia have begun partial strikes today after talks failed to reach an agreement. Now, for more on all of this, we're joined by Bloomberg's Will Kennedy. Now, Will, thank you for joining us. We knew that this wasn't going well, but actually it's incredible. There are 2 facilities in Australia, and if you look at the 2022 numbers, they accounted for 7% of global LNG.
So this could become a big deal for the gas market. I think it's worth bearing in mind that it will happen gradually. They start some sort of go slow measures over the weekend, and then on the 14th, that's when they walk out entirely, and it would probably stop the production of LNG. So it will take a little while to seep into the market, but as you say, there's a lot of gas at stake in a global market which is still fairly tight after the war in Ukraine.
Well, I think a lot of people were surprised. We were expecting this, and we knew that they hadn't found an agreement with, of course, the trade unions, and yet at the open, the price of LNG, went up by 11%. Or what does that mean?
It's come back a little bit now. I think that's probably a reaction to the fact that the rhetoric from the union in Australia is extremely strong, and the noises that we're hearing for them is that they don't see a landing zone for a deal at this point that aren't expected, and it's becoming clear and perhaps clearer that there won't be substantial negotiations over the next few days. So I suspect that the market is adjusting to the fact that it's now accepting that this strike is likely to happen and may have an impact.
So how long could this last? And I don't know, is it impossible to model, like, every extra week the strike goes on? How much does it impact?
Well, at the moment, I think the full walkout starts on September the 14th and then lasts for 2 weeks. But clearly, if there's no deal, then there's more industrial action in the offing, and we get closer to that time when demand will rise in the Northern Hemisphere in the winter months. Now, stockpiles are fairly full in Europe right now, but we are vulnerable to cold weather over the winter, cold weather in Northern Europe. And so as we get into the autumn, and if we're denied the 7% of global supply, I think it will change the equation for many gas traders.
The strike, Chevron wouldn't do that. Or they, I know we don't know, but it just seems like a big gamble for the world economy. And if there is an agreement, can they just switch it back on like this?
Well, they can switch it back on, but with these big plants, it always takes time to get things up and running. There'll be lots of safety checks that they have to do, and the schedule they have of loadings will be knocked out of kilter. So it will have an impact, but they can presumably work to get things back on strike. I think what you say is true. Clearly, Chevron has an enormous incentive to have a deal. Woodside, which was the other company involved in these talks in Australia, did reach a deal with unions, which is why I think the market might be a little surprised that things have broken down in the case of Chevron. It will presumably get resolved sooner or later. It's just a question of how soon or how late.
Yeah, well, thank you so much, Will Kennedy there, our Senior Executive Editor for All Global Commodities. Coming up, we hear from New York Fed Chief John Williams on where U.S. monetary policy is ahead of the Fed's September meeting. That's next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again to make sure that we're keeping that steady progress in terms of getting the imbalances, shrink imbalances in the labor market and bring inflation back down?
Well, that was New York Fed President John Williams speaking exclusively to Bloomberg about the Fed's rate path ahead. Now, with an eye to the Fed's rate path and wider markets, we're also joined by BlackRock senior investment strategist Laura Cooper. Laura, how many times do you look at dollar a day? It's like dollar, it's up. Oh, no, it's down. What does it mean for the rest of the world? I mean, is this going to be the big driver?
I think certainly the dollar upside that we have seen more recently has surprised our expectations. We question the sustainability of that, largely as we look forward to the Fed. We do think that the Fed is probably going to signal a hawkish pause, because if we look at some of the indicators that have come through in terms of labor market tightness is easing, we are seeing signs of moderating job growth, so some of those tailwinds for the dollar are likely going to fade as we head into the back end of the year.
I don't know how you communicate a hawkish pause, because once you pause, does the market just assume you're done and even maybe bring forward some of the cuts priced in?
And I think that's the key risk that the Fed wants to avoid. They want to keep the optionality open. They want to suggest that they're going to continue to remain data dependent because they don't want those easing expectations to be pulled forward. If we look for what's priced in 2024, it's already quite aggressive for just over 4 rate cuts, I believe. And so that's starting about May or June of next year, which does suggest 1 cut at every meeting nearly, which does appear too aggressive, especially when we think about this is an environment where inflation still remains above that 4% range. They're going to keep rates in that restrictive territory until they see meaningful signs of that disinflationary trend becoming entrenched.
So what does that mean for what you're buying right now? I don't know if it's T-bills or anything longer ended.
I think if we look at the U.S. rates complex, certainly we have seen that back up in the 10-year Treasury yields, really testing those cycle highs once again. And the key question is, okay, is now the time to really buy that dip? Not yet. And I think that's largely because the inflation outlook does remain quite uncertain. And we do think that investors are going to demand that higher compensation in this elevated inflation regime. And particularly if we look at the kind of the front end of the curve, we do think that there's still attractive income opportunity there, provides a little bit more support, because even if the Fed does pause, you're going to get some of that capital appreciation. But our view is that we're going to see those elevated yields around that 5% mark for quite some time. So why take the duration risk?
Makes sense. Talk to me about Europe. So Europe, actually, we're seeing a deteriorating economic backdrop, but at the same time, and we have LNG today that will directly impact, of course, Europe. So it complicates matters for the ECB.
I think certainly the growth backdrop does complicate the matters for the ECB. Notably, if we look at those leading indicators in PMI gauges, it does suggest that we are going to see Europe in contraction by the end of the year. And especially if we look at the recent release of Q2 GDP revisions, does suggest a very weak handoff to Q3. At the same time, inflation does remain elevated. We do have that headline measure about 5.3%, and it is tracking in Q3 above the ECB's forecast for about that 4.7% mark. So it does suggest that the ECB will take the opportunity to hike its policy rate next week. We think it certainly is a loose conviction call for us, but I think there's less certainty from them that they're going to have that optionality to hike later in the year when that deterioration in growth becomes more pronounced.
But Laura, overall, I know this is a bit maybe philosophical, but is there a real danger of over-tightening at this point? Is this maybe we talk about 25 basis points here or there, and maybe traders are largely ignoring the huge impact? I mean, could this be the one that tips the balance?
I think that is really the key risk, and it's something that we just heard from comments from the Fed speaker in the sense that they want to ensure, is this actually sufficiently restrictive? Where is those neutral rates? And it's really hard to determine in this environment. But that being said, they really focused on that realized inflation rather than those indications of forward inflation expectations, which does suggest that they're going to take the opportunity to hike now rather than the risk that they are still behind and they have to hike later on. I think interestingly, if we look at inflation expectations in Europe, as evidenced by those five-year forward swaps, the fact that they have risen, they're about that 2.5, 2.6% mark. Isabel Schnabel more recently did suggest that that's a bit concerning because it does suggest that markets are losing confidence that policymakers can bring inflation back to 2% targets. So they want to get ahead of that. They want to keep those inflation expectations closer to where their target is.
Laura, what does it mean for European government bonds? And also shout out to Dan Curtis on our team that got me that exact chart earlier this week.
So I think one area where we are seeing more comfort because of the growth dynamics is taking on long duration exposures in European government bonds, in particular core. And that's a high conviction view over what we are seeing in U.S. Treasuries because the growth backdrop in the U.S. does remain fairly resilient. So as we start to see more of that deterioration come through in European data, we are taking more comfort in taking those exposures in longer end rates, but as well as some of that high quality credit exposures as well.
Okay, then we have the UK, where you believe that signs of household stress are yet to come. And then we have this incredible story that we'll also cover extensively at the end of the show. I mean, to rent a room in London, a room, not a house, not a little flat, is more than £1,000 a month. I mean, what does it mean for the consumer?
As somebody who lives in London, I can't say I'm that surprised by that indicator, but I think certainly it does reflect Governor Bailey's comments that we had earlier this week, where he did suggest that they are near the end of their hiking cycle, largely because we've seen this marked decline in inflation. He does expect that to persist, but he did acknowledge that the lagged and variable policy, monetary policy, will take some time to feed through, and we have yet to see the full impact of that. So in our view, it does suggest the BOE is going to hike one or two more times and then pause to assess the effect of that cumulative tightening to date. That's largely in the price. That's why we are taking more exposure in gilts, for example, at the longer end of the curve, because we think a lot of that is already being reflected.
Because people thought actually it was worst case scenario for the UK, and it looks a little bit better, I guess.
It does look better. In terms of what we've seen from recent GDP data, has been revised higher. We are seeing growing signs that labor market is showing some signs of softness, which does bring some reprieve to the Bank of England members, but I think it's just too soon at this point to clearly see that that's going to have a very negative impact. So far, they want to continue to hike to keep inflation expectations anchored.
Okay, Laura, this is the Cooper big number of the day. So we every day we find a big number, and today we actually looked at this, and we kind of had today a double take. So Apple's two-day slide has sapped $190 billion on the valuations of Apple. I mean, this is pretty incredible, and this is as China plans to expand a ban on the use of iPhones to government-backed agencies and state companies. When you look at tech, I mean, this is incredible. It's understandable given the noise we're hearing from China, like 3 days before. Yes. Also, they have to release a new iPhone. But all of this trade war or noise, what does it mean for not only tech, but the rest of some of the U.S. equities?
Well, I think given the fact that we have seen this, quite relentless run-up in tech so far this year, yes, we've seen that come under pressure more recently. It doesn't necessarily suggest that we've seen an inflection point where the defensively tilted tech sector will continue to come under pressure, largely because if we think from the past earnings season, this is showing signs of sustainable profitability. We look at those earlier cost efficiencies efficiencies that were put in place earlier this year. We do think that's going to spill over into bottom lines. So ultimately, this is still going to be a sector that's going to continue to meet those still elevated earnings expectations. If we look for tech, EPS estimates for the next 12 months or so are above 14%. If we think that's probably the only sector where the demand dynamics are sufficient enough for them to actually be able to meet those market expectations, we have less conviction if we think elsewhere in the sector complex.
Laura, as always, thank you so much for joining us. BlackRock Senior Investment Strategist there, Laura Cooper, touching, of course, on gilts, T-bills to Apple. Coming up, underperformers at Goldman Sachs could be shown the door as soon as next month. That's according to the FT. More on that report just ahead. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. There's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Now, U.S. lawmakers say China's top chip maker, SMIC, warrants investigation as the company appears to have violated U.S. sanctions by supplying components to Huawei. Now, Tech Insights in the company, which Bloomberg News worked with to break down Huawei's new Mate 60 Pro smartphone and uncovered the technology inside. Well, we spoke to their vice chair, Dan Hutchinson, earlier.
The big significance is it shows that China's been able to
get around or at least, get forward on some of the sanctions that were on them that limited their access to 7 nanometer equipment technology and beyond 5 nanometer, 3 nanometer. So the result of it is that they've been able to clearly get from the 14 nanometer to the next generation, which is 7 nanometer. And it's a pretty clean looking device in terms of when we got in and we looked at the devices. So it shows that there was a really lot of excellent engineering on the part of the SMIC engineers to bring this part to market.
We had a previous guest who said you take a look at this and, does that kind of tell us that the whole tech Cold War has been pretty useless? Would you go so far as to say this is a breakthrough for China to the extent that the curbs from Washington have been ineffective?
No, not at all, because the rest of the world is at 3 nanometers going to 2 in the next year. So you go from 14 to 7 to 5 to 3 to 2, right? So they're still back 2 nodes, and the original objective of the sanctions was to keep China's fabrication capability 2 nodes back. And so there's still 2 nodes back. It's just that people had thought that based upon the equipment technology that was restricted there, that they would only be able to get, they wouldn't be able to get past 14 nanometer without a lot of yield loss. But the tool sets that they have is the same pretty much tool set that TSMC and Samsung used for 7 nanometer.
If you take a look at the progress since TechInsights actually found last year at the Bitcoin mining machine, the 7 nanometer to now, has the pace of progress surprised you? And do you think you can extrapolate that to say what happens in the future?
I wouldn't say it was surprise. In fact, we'd pretty much predicted that this was going to happen, and it was just a question of when we would see it. We knew that the bit mining device was really crude and very poorly done. With access to more immersion deep UV tools, they would be able to get further down into the dimensions. They could get much cleaner patterns. And as they just simply, did the grind of the engineering, that sort of thing, it really brought them up to speed and was able to pull this device off. So that at least it can be done in volume, where the bit mining coin was not a really manufacturable device.
That was Dan Hutchison, Vice Chair at TechInsights, speaking to Bloomberg. Now, Hong Kong's heaviest rainstorm since records began in 1884 is also flooding the financial hub's streets. I think we have pictures of that. It sent torrents of water rushing through subway stations, bringing much of the city to a standstill and forcing the stock market to scrap trading today. So, of course, we'll keep a very, very close eye on this. The downpour, which actually caught many residents off guard, comes just a week after super typhoon shut the city, causing government to issue its extreme conditions warning. Coming up, we'll bring you the latest on the G20 summit, including the news that President Biden is not planning to meet President Xi at Premier Li at the event.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, Their product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Slice through the noise. Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Now, European gas prices jumped after workers at key Chevron sites in Australia began long-awaited strikes in a dispute that's roiled global energy markets. Apple continues to weigh on the Nasdaq, the tech giant losing nearly $200 billion since Beijing decided to curb iPhone use. Plus, Goldman Sachs is reported to be moving to fire underperformers as soon as next month. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So we've had overnight news that from the U.S. that President Joe Biden does not intend to meet with the Chinese Premier Li Qiang at the G20 summit. Well, Bloomberg's Menaka Doshi joins us now from Delhi. Menaka, thank you for bringing us up to date with exactly what's going on the ground. What's on the agenda, and what are the implications, actually, of President Xi and Putin not coming?
Good afternoon, Francine. A variety of things on the agenda. I won't get to all of them, but critical for the G20 to find consensus and make progress on issues surrounding transition finance and climate change, the reform of multilateral development banks, and also the debt restructuring of lower-income economies. Besides this, like you pointed out, unfortunately for India, which wanted a picture-perfect G20, it is going to be marred by the absence of the presidents of Russia and China, specifically China, given that no consensus on any of these critical issues can mean much without China's participation. So that will continue to be a regret for India when it comes to the G20. But it also creates space for India to assert its desire to lead the global south, given that China is not in the picture right now. It also creates space for the U.S. to be able to reach out to member countries of the global south and rebuild some of those fraying relationships. So that's what it's looking like right now this Friday afternoon in New Delhi before we kick off the actual summit over the weekend.
So, Menaka, now for the U.S., I guess, take on things. We heard from the U.S. Treasury Secretary Janet Yellen about this. So let's take a listen to what she had to say.
In spite of obvious problems due to Russia's war against Ukraine and Russia's, general absence from G20 initiatives, I believe the G20 has been extremely effective.
So, Menaka, what did you make of her comments?
Well, in a sense, Janet Yellen is pointing to the fact that there will be outcomes despite the absence. Earlier on in the week, President Biden had mentioned he was disappointed that China's Xi Jinping was not making it to the G20. Now, there are a couple of things to factor in here. I think how the Western nations will weigh in on the language used to describe the Russia-Ukraine war. That will be critical to whether we will have a communique or not at the end of Sunday. And if we don't have one, that'll be the first time in the history of G20 that we don't have a communique. What will replace it then will be a leader statement which will outline the areas of agreement or consensus. So that's one thing that we're watching out for. Besides that, we've seen the leaders of Western nations point to some of the differences with China on issues of, let's say, semiconductor technology. I think, the British leaders, Rishi Sunak mentioned that on his way to India. So we're waiting to see how the West will respond to the issues that China has raised, even though its leader is not here in the country, and also the wording of the communique.
Thank you so much, as always, Menaka Doshi. They're from the G20. Now, Goldman Sachs is reported to be planning to dismiss underperforming workers as soon as next month. Now, the FT says the cuts are part of the Wall Street firm's annual staff evaluation. For more, we're joined by Bloomberg's Steve Ahrens. Steve, always great to have you on the program. Thank you so much for joining us. I mean, it was basically that there was a moratorium, right? That during COVID, Goldman tried not to fire too much staff. Are they just going back to what they used to do before?
Well, you're right. I think Goldman Sachs has been trying to get rid, really, of workforce that built up during really a hate time. I mean, remember 2021, but also 2022 was a time when investment banking was booming. It's been slowing down a lot, and so a lot of banks, but Goldman Sachs at the forefront, have been cutting down their workforce. This now seems to be really an annual exercise, and if it's actually really at the bottom sort of range of the annual exercise, then maybe it's just something regular.
So what does that mean, Steve, going forward? I mean, we talk so much about Goldman Sachs, and it's very rare that there has been, if not a revolt, certainly that the chief executive has had so much negative press. Does this change from within staff if bonuses go up?
Well, I mean, higher bonuses always make people happier, right? So everything else being equal, yes, people will be more happy. Will it be enough? I don't know. I mean, you're right, the negative press Goldman has been experiencing has been really quite unique. I mean, I remember a time Goldman was so much in the press for the wrong reasons. And the CEO actually said yesterday he thinks that he's been made a caricature. Clearly, it's taken a toll on him. Higher bonuses will be one way to address that. I don't think it would be enough.
So what comes next for Goldman?
I mean, it's a long slog, right? Once you're in the press like this, once a narrative, you need to get out of that situation. They need to show now consistently that they're on the right track, that they're not making any more strategic mistakes, such as a retail foray. And if that happens, then at some point, it will turn around and become a positive story again, but that will take a lot of effort. It's not going to happen overnight, and one set of good bonuses is not going to be enough.
All right, Stephen, thanks so much. Steve Ahrens there from our banking team, of course, on the very latest with Goldman Sachs. Now, the Canadian Prime Minister, Justin Trudeau, says there's no room for rapprochement with China, as President Xi Jinping's muscular foreign policy has made a normal relationship between the countries impossible for now. Trudeau spoke exclusively to Bloomberg's Eric Chapster in Singapore as part of a new Bloomberg New Economy series, Beyond Borders.
The way it's always been framed for our allies, whether it's in Europe or elsewhere, is the desire of access to markets, particularly the growing and engaged Chinese middle class that represents, a tremendous benefit for us. And over the past many years, there have been lots of friendly and sometimes less than friendly competition between allied countries. Whether it's Canada versus the U.S. versus Australia versus Europe for, can we get more beef in to China, we get more pork. And China's been very thoughtful about making sure that they just would play us off each other just a little bit in strategic ways that has been very effective. So for me, and certainly for the G7 as we've had conversations around this, the understanding that we cannot simply be trying to elbow each other out of the way for access to the Chinese market, but we need to be more thoughtful and concerted in how we move forward. Nuanced in our approaches is really the only way to go. I don't think the idea of crossing our arms and turning our backs on any part of the world is something that is good for the Canadian economy or Canadian people, but not being naive, being very deliberate about how we do it, and working in concert with our friends and allies is the right way to do it.
You mentioned the chill that settled onto the Canadian-Chinese relationship after the case of the two Michaels, as it's known. You've also made reference to in Canadian democracy. Is there political space in Canada for a rapprochement with China?
A rapprochement, no. Certainly not at this particular moment. China has made decisions over the past years that have made it more difficult, not just for Canada, but for other countries, to engage in ways, I will admit, in 2015, the conversations we had was about working on towards a free trade deal with China, working towards those sorts of things. But in real terms, the choices and the actions of China have made that more difficult. But like I said, we will continue to look for ways to engage constructively in ways of mutual benefit and try and rebuild a positive relationship in the interest of Canadians. But we're not going to be naive about it.
That was the Canadian Prime Minister Justin Trudeau saying there's no room for rapprochement with China. He was speaking to very own Eric Schatzker over in Singapore. Coming up, why employees want a workplace reset. We'll discuss the findings of Edelman's new trust barometer with its chief executive, Richard Edelman. That's next, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, with climate change among the key items on the G20 agenda, the spotlight is on the host nation's efforts to reduce carbon emissions. India is aiming to reach net zero by the middle of this century, even as it tries to meet the energy demands of its rapidly growing economy. Well, Bloomberg's Manaka Doshi takes a closer look at the challenges.
From electrifying public transport to solar rooftops to small urban solar parks like this one to the world's largest solar farm, biogas, hydrogen, India's throwing everything it's got at its energy problem. A problem of both demand and supply. An Indian consumes less than a third of the energy an American does on average. But there are 1.4 billion Indians, making it the world's third largest energy consumer. Rising incomes, industrialization, and urbanization also mean rapidly rising energy demand, supplied mostly by hydrocarbons. Coal powers 70% of India's electricity. The country has the second largest reserve in the world. Petroleum products power transport. Over 80% of the crude oil is imported, posing a budget risk. Which is why India is aggressively pushing public and private investments across green energy, using a mix of local production incentives and import tariff barriers. The progress has been encouraging. By 2030, almost half of India's power generation capacity will be solar, wind, and hydro. Electric vehicle sales tripled last year, though they are a fraction of overall sales, and green hydrogen has drawn multi-billion-dollar bets from leading conglomerates. But there's still batteries, storage, grid transformation, so much to do. Last year, India spent $16 billion on green energy technologies. It needs at least 10 times that investment every year to 2030 to get on track with net zero. India needs to get this energy transition right. It would not be an exaggeration to say the future of the planet depends on it.
And we'll have full team coverage, of course, of the G20 in New Delhi, where we have Rishi Sunak just arriving for the summit. It was very clear over the last couple of days that President Biden of the U.S. now aims to seize this moment on the absence of two key adversaries for the G20, which is China and Russia. So the Russian President Vladimir Putin, the Chinese President Xi Jinping, both opted to skip this year's gathering, which means that Biden now has an opening to reestablish the U.S. as a pole star of this international system. So any Joe Biden, Rishi Sunak, of course, meeting will be crucial to that. I guess, President Biden will also want to do overtures towards Brazil, South Africa, and Indonesia, not to mention the host, India. But it's always quite moving and quite telling to see how these, world leaders interact. Of course, central to all world leader or every world leader effort to push is to try and figure out also the fund and scope of the World Bank and other development banks. And again, they're all probably going to try and deepen ties with some of the emerging economies and offer an alternative to China's state-backed lending. Again, Rishi Sunak and the UK could have a crucial role to play in this. We know that the US, for their part, plans to push for debt relief for poor countries, but also announce funding for new infrastructure projects. Biden, after that, will then visit Vietnam. It'll be interesting to see whether Rishi Sunak will spend a lot of efforts also going elsewhere in some of the emerging markets. Now, former FTX executive Ryan Salame has pleaded guilty to 2 criminal counts and has agreed to surrender more than $1.5 billion to authorities in connection with the dramatic collapse of the cryptocurrency exchange. Well, Bloomberg's Sue Keenan has more.
Former FTX exec Ryan Salem has now pled guilty to charges connected to the extensive fraud case against Sam Bankman-Fried. Salem joined FTX in 2019 and was a prolific political donor. He also bought a private jet and opened restaurants while the co-CEO of the now bankrupt crypto exchange's Bahamian subsidiary. As part of the plea arrangement, Salem pled guilty to 1 count of campaign finance violations. He says he made millions of political contributions with FTX funds at the direction of Bankman-Fried, and 1 count of illegal money transmitting. He was freed on $1 million bond, agreed to surrender more than $1.5 billion in assets, and did not promise to testify against Bankman-Fried, who was arrested in the Bahamas in December of last year and now faces trial in October. Notably, Bloomberg reporting shows that when the issue of potential fraud at FTX first came to light, it was Ryan Salem who had brought the case to the attention of Bahamian officials, reporting that customer funds may have been commingled. This latest plea arrangement clearly strengthens the prosecution's case against Bankman-Fried, who had his bail revoked by a judge due to evidence of witness tampering and is now awaiting trial while in jail. Bankman-Fried lost a bid earlier this week to get out of jail for a few hours a day to help his lawyers prepare for his case. That decision is now set to be reviewed by an appellate panel. Sue Keenan, Bloomberg, New York.
That was Sue, of course, with the very latest on FTX. Now, coming up, the cost of renting a room in London tops £1,000 a month for the first time. More on that next, and this is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
My first car was a Volkswagen Beetle.
The first car was a Volkswagen Beetle.
Today, I'm in the very grateful position, being able to test a lot of cars.
It was a VW, it was an old Golf, one of the first examples.
My very first car was a VW Golf 1.
The VW Polo that I purchased, and that tells you how old I am, still for Deutsche Mark, not Euro.
A Corsa, very first generation, a Corsa A, back in 1995.
My first Mercedes, and I think that's even more important, was a C-Class in the early 90s.
I didn't have my own car, so I was driving my mom's Oldsmobile.
It was a smaller car, and I developed myself
an F-150 pickup truck, manual stick shift in farming country.
When welding the unfortunately rusty floor, I actually set the rubber
fuel pipeline on fire.
What was a Fiat Panda with an ugly, kind of blue, pale blue thing and beige interior. And then I had also a Renault 4, white Renault 4. That's why, it's something special for me to make it again.
Well, car makers and industry leaders are talking to Bloomberg at IAA Mobility at Munich about their first car. We also take submissions, of course, on social media. So please tell us your first car. We may tell you what our first car here is. Right now, it's all about electric as legacy companies scramble to catch up with Tesla and Chinese EV players. Now, Letting's website, Spare Room, says the average cost of renting a room in London has topped £1,000 a month for the first time. Joining us for more on the story is Bloomberg's Eamon Farah. Eamon, thank you so much, first of all, for a great story. I mean, it's shocking. £1,000. I mean, we all know if we rent in London that prices have gone up so much. But what exactly is driving this?
Yeah, so you said £1,000 is a huge number now. This is kind of for the average single room in a flat or a house in London.
For a room. This
Just
is the thing. Like, a lot of foreigners will be like, for a room?
Just a room. I mean, what's driving this? You've had this long-term kind of lack of housing stock in the UK, which means that, for a long time, it's been a bit of a struggle. But recently, with the rates that have gone up so sharply, mortgages are much more expensive. Lots of buy-to-let landlords are actually selling up and exiting that market, which means there's a bit of a lack of supply. And at the same time, people who maybe would have moved off of the renting, market, would have bought a house, they're staying renting for longer. So we just have more people in this market and just not enough properties. So you have about 6 people, every room available on the platform right now.
So what's the outlook for the London rental market right now? Does it just keep on rising? I mean, this is a huge cost. We're talking about cost of living crisis. This is it.
Yeah, I mean, this is exactly it. And the thing is, this kind of £1,000 actually holds back jobs, it holds back growth. People who would have been able to move to London and just start a job, start education, they are being held back and they aren't taking those opportunities. Where this is going, we are seeing a point where rates are maybe starting to peak. We are seeing the fact that mortgages in the next couple of years could come down. But the issue is, and what we're hearing is that if mortgages come down and there's savings for landlords or savings for investors, it doesn't always pass on to the renters, it doesn't always pass on to the youngest people. So it could be some kind of embedded inflation that stays for a lot longer.
Yeah, I mean, this is the thing, because actually wages may not, increase as rent does. Does it just mean that people will have to pay a bigger chunk of their salaries to rent?
Yeah, exactly. And in London, it's already a huge amount. I mean, £1,000, if you kind of have the average salary, it can be up to 40% of your salary going towards that. And that means that you cut back on other necessities. It means you've got to maybe move further away. And it causes so many issues, as I said, for the labour market. Labour shortages are rife in this capital. That is also because accommodation is becoming so difficult, as we can see right now.
Is the government doing anything about it? Can they do anything about it?
I mean, the government is definitely, focusing a lot on the kind of more housing side of things, as in the more residential, purchases. The Bank of England on Wednesday were talking about how this is quite concerning, how the impact of rates on the rental market, but that, you have to kind of do this to drive down inflation. That's the most important thing right now for the country.
All right, thank you so much, of course, for all of your great reporting. That was Eamon Farah there with the very latest on, I mean, it's crazy, £1,000, folks, for one bedroom in London. We've never seen prices like that. Let's also have a look at what Apple has been doing. This is our big number. Thank you to Dan Tillis, TV Dan, for bringing us a big number every day. So this is our big number, and it's basically $190 billion have been wiped off Apple's valuation in 2 days because China is curbing or is putting some exceptions, of course, on iPhone. Apple, for the moment, pre-market, gaining some 0.2%. Of course, it's not a huge deal. We'll continue keeping an eye on Apple, but if you look at how much they've lost over the last couple of days and the fact that the timing of this probably couldn't be at a worse time because we also have the new iPhone being released in a couple of days. So Apple now looking to stave off a crisis in China. This is just days before the launch of its next iPhone, an already high-stakes event that will test whether new features can shake the smartphone industry out of doldrums. Up next, Bloomberg Surveillance, early edition. This is Bloomberg.
Almost half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Apple loses nearly $200 billion in market value just days ahead of its next iPhone launch. The high-stakes event risks being overshadowed by multiple controversies in China. The dollar snaps its winning streak as investors focus on dovish comments from Federal Reserve officials. New York Fed President John Williams tells Bloomberg policy is in a good place. And Goldman Sachs is said to be moving to fire underperformers as soon as next month, bringing an end to its pandemic freeze on job cuts. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, in for Danny Berger in London with Sonali Basak in New York. And Sonali, we started the European session on hopes that maybe we would snap 7 days of losses, but the sentiment has again turned negative.
Same here in the United States. When we're looking at the S&P, we're looking at another day of losses, down about 0.2%. This is the Friday ending a week of losses. After a week of gains here over in the United States for the S&P 500, we're finally looking at some cooling, though, of the two-year yield. We're looking at a 493 handle. This earlier in the week had surpassed 5%. And so this cooling is about flat today. But again, we have come down from the highs of this week. Now, again, with the cooling of yields comes the cooling of the dollar. This has been defying gravity all week long, really pushing global markets into new territory here and historic levels in some Asian currencies as well relative to the US dollar. Finally, some cooling into the weekend here on some dovish comments, as you've been saying, from Federal Reserve officials. But we do have CPI next week, so a lot more where that came from, Tom. We're also looking at Brent crude earlier this week, surpassing 90, ending the week now looking at an 89.75 handle. This is about 0.2% lower on the day.
Yeah, well, energy is obviously consequential for Europe as well. So we factor that in as we look at the European benchmark. European stock 600 down by 0.5%. But again, I will remind you that at the start of the session, we were seeing some upside for European stocks, now turning lower, of course. So it looks like, at least from now, we are set for 8 straight days of losses. Still early days, of course, in the European session, but potentially straight days of losses for European stocks. Euro, dollar, the single currency is getting a little bit of a lift this morning, up 0.1% at 107. We look ahead, of course, to that really important meeting from the ECB, September the 14th, and a Bloomberg survey just pointing out the split nature of the views amongst economists as to whether or not they hike or go for a hawkish pause. Natural gas, you talked about oil, the natural gas story is in focus for us as well, given the strike action in Australia, accounting for potentially 7% of global energy coming out of that nation. Strike action there linking to the workers who work for Chevron. That price now up close to 7%. And of course, we think about the winter months in Europe. Stockpiles, though, and inventories remain relatively high in Europe.
Now, we're keeping an eye on Apple shares. Big story of the week as the company looks to stave off a crisis in China just days before the launch of its next iPhone. Joining us now is Bloomberg's Alex Webb. Alex, when you look at the issues that Apple is facing in China, how much is their business at risk in the country?
Well, there are two pieces to this. On the one hand, there's what we know. It's been reported from our colleagues from sources, namely that China is cracking down on the use of iPhones in state-owned ministries, but also enterprises, companies like PetroChina, who between them employ millions of people in China. Now, that in and of itself is not all that significant for Apple's sales. There's some estimates that it sells in the order of 45 million units a year in China, significantly less, maybe 500,000 would be at risk from this. The bigger question, therefore, is there something about the mood music? There are times in the past when there's been a sort of resurgence of nationalism when it comes to purchasing, and that is around the fringes hurt Apple's sales in the region. Is that going to be the case then with the next iPhone cycle? That seems to be the bigger fear that may be informing some of these stock declines.
Yeah, and it's a reminder that they can send Tim Cook over there to kind of kiss the ring, but it's not necessarily going to put an insurance around Apple forever when it comes to national security concerns.
One caveat to that, of course, is that, they are symbiotic. Apple employs millions of people indirectly in China, so it does need Apple to an extent as well.
Okay, just very briefly on the Huawei investigation around the SMIC chip by the US.
Yeah, so the US is looking into this chip, which is in the brand new Huawei phone. There's a suspicion that maybe some sanctions were breached in order to make it. SMIC, which is the Chinese contract semiconductor manufacturer, makes them under the designs of other people. The fact that they've been able to make this pretty high, bleeding edge chip, not the latest generation, but close to it, has been a surprise. So the US is now looking to see if something untoward happened to make it happen.
Okay, Alex, there's finger on the pulse for all things Apple and the consequences in terms of their exposure to China. Thank you. Now, we're also, of course, watching the yuan as we talk about China as the PBOC set its weakest fixing in 2 months. Bloomberg's Valerie Teitel joins us with the latest. Valerie, there's been a bit of a turnaround for the yuan. And what does this tell us about the sentiment of the PBOC? Are they expecting now, are we seeing them moving some obstacles out of the way for further downside as they look maybe to the export engine of China?
Well, look, Tom, that PBOC fix overnight was the first time they have set it above the 720 handle since June, and is possibly raising questions that they might let this currency slide more. They have been quite unsuccessful in stabilizing this managed currency this week. We have seen CNY weaken by 1% just this week, and the offshore yuan is nearing all-time record lows since its creation in 2010, and just overnight, even the onshore currency hit a fresh 16-year low. So a bit unsuccessful in the PBOC stabilizing the currency. It is causing some other problems that we want to keep an eye on, Tom. Note that this currency invention is effectively taking yuan out of the financial system, and it is causing some liquidity issues. It's been exerting pressure on funding costs, and yields on short-term rate instruments in China have seen their biggest one-day move this year. We should also note that the PBOC hasn't just been manipulating in the spot market. They've also been manipulating in the forward market, trying to make it more punitive for speculators to short their currency.
Now, over in the United States as well, we have to look ahead because investors are expecting Fed officials to hold rates steady when they meet later this month, with policymakers having a fresh inflation data print to review before then. We spoke exclusively with New York Fed President John Williams yesterday.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do.
Valerie, how does all of this set us up for next week?
Look, there were no major bombshells from Fed officials this week, most of them mirroring various comments that Powell even made at Jackson Hole, saying the need to proceed carefully with hikes, that they don't see any need for any imminent action. All of this points to the fact that the Fed will likely go on hold in the meeting in 2 weeks' time. It is important to note, though, we did get some information on wages yesterday from two sources. We had the Wall Street Journal reporting that Walmart is now reducing wages for new employees. And as this chart here on TV shows, the Atlanta Fed wage growth tracker is showing more moderation in the wages in the U.S. We've actually seen them now cooling to a 2-year low. So all that progress on wage inflation, even though the labor market arguably still stays very tight, is good news for the Fed. And we have seen the front end rally a bit after this news, with now positions raising an eyebrow to whether the Fed will actually need to go and hike when it comes to their November meeting.
Okay, Bloomberg's Valerie Teitel, thank you. Let's get to what's happening then in terms of the fate of Goldman Sachs. According to the Financial Times, Goldman Sachs plans to dismiss underperformers as soon as next month. That's as part of the Wall Street firm's annual evaluation of staff. Goldman managers have started drafting lists of those who may be cut, and the final numbers are still being set. Shonali, you followed this story very closely indeed. On one level, this isn't a big surprise, as of course you know. They're resorting to a method of cutting headcount that they used to put in place pre-pandemic. But it is also significant in terms of the timing, and of course we wait for the numbers.
On one hand, it's also feeling very early. It's only September. But on the other hand, it also provides some certainty, doesn't it, Tom? They have cut thousands of jobs. It has been a tough year. You're watching a year where Goldman Sachs and other banks also are facing their returns on equity under pressure. We are weeks away from a third quarter print. They have made massive changes to their consumer business, and this looks like a lot of housekeeping coming early to start 2024 quite fresh, isn't it? The number of jobs is about 400 or so. These cuts come annually, not just for Goldman Sachs, but also for its rival banks. And this is a wake-up call not only for Goldman bankers, but also for its rivals, isn't it?
And Shonali, we've had David Solomon, the CEO, of course, coming out and trying to defend his character and push back against what he describes as some attacks in the press. What do you make of the focus on the CEO?
There is intense focus on the CEO, but at the end of the day, this is a matter of performance, isn't it? Which is why I bring up that third quarter print. If we think about it, if they can show some clean numbers here in their third quarter, we can look at him coming out quite cleanly, can't we? It's at the end of the day what the investors and the board want to do, and it comes down to what the numbers shape up as.
Yeah, so I mean, the message from the comms team and others is, look, these are partners who are kind of aggrieved because they haven't had the bonuses and the kind of comp they may have been expecting. Also worth noting, of course, over 5 years, Goldman has performed pretty well. Under his tenure, up about 50%, even slightly better than JP Morgan. What do you think? What are the next things to watch? You've got the next set of results. How much progress is made on the retail business? Because that has been a misstep, at least in the view of many.
Well, on one hand, you have them selling off their Marcus loans. You have them starting to get rid of some of the businesses. Very close to be having a Green Sky sale. I'm sure they want to get that off their books by the time they are reporting, if not nearly after. They also have that sale of that United Capital business, which is going to come in at a gain relative to a loss, as we've seen with that Green Sky write-down that they've already taken. So there is a chance the worst is over. If there's a little more messiness, they do have to explain it. Tom, there's a little bit of a silver lining here for Goldman Sachs, and it's the return of deals. They are, I believe, 40% of the IPO market lead left underwriting here. It's a very significant share, so they might be able to point to deals coming back should this market hold up. But that's also a question of the markets, let alone performance.
Yeah, okay, so we watch that deal flow and wonder whether or not what we see from ARM is going to lift sentiment in terms of listings, at least in IPOs. Shonali, of course, few better placed to talk Goldman Sachs. Coming up later this hour, a growing risk of overextended levels for tech stocks. That is the view from Aberdeen's Luke Hickmore. More with him later this hour. And President Biden heading to India for the G20 summit. The key issues then on the agenda. President Xi will not be there, neither will Putin. But we've been hearing from Treasury Secretary Janet Yellen. Plenty more from the G20. This is Bloomberg.
the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance Early Edition. We want to bring you to the bond market because we were watching record corporate bond issuance earlier this week on Tuesday. Just take a look at how much more was issued in bond markets. This is the relative calm you're seeing in the market, as well as a market that has been trying to get ahead of a CPI print that could really change the calculus on the direction of U.S. interest rates, at least according to what the market believes. Now, this is all in the United States, and this investment-grade issuance can pave the way for leverage borrowers, for riskier borrowers, and those are the borrowers that we have seen drop off the market pretty significantly this year. And joining us now to talk more about this issuance, can it continue, is Dana Al-Baltaji. She's Bloomberg Managing Editor for Credit. Dana, when you take a look at this issuance, you've got to ask, can it continue?
I ask exactly the same thing. And you know what that tells me? That tells me that issuers have learned that when you can sell bonds, do it. Do it as fast as you can. Do it so long as the market can take it and sell as much as possible, because we have seen that there are periods when the market absolutely cannot absorb that amount of debt. So I'm not surprised at all to see that issuers are trying to take advantage of this. And I'm also not surprised to see that leveraged borrowers are trying to tap the market, more so in the US, obviously, because the market has not been as shut in Europe as in Europe, where we had seen like a long dearth of junk debt. But it's very important to note, though, even when we are looking at junk debt issuers tapping the market, it's still the best of the best. So we're not looking at very low-rated junk borrowers. It's mostly highly rated.
Dana, is this issuance coming across the board, or is it particularly focused in one area? And what has demand been like?
So demand has been really significant, mostly because you've got a lot of investors that had been waiting for this, so they've budgeted for this flood of sales. But because it's September, and September is one of the 2 months where you usually do have a flood, we're seeing issuers of all kinds. This is not just one particular sector. It's all sectors. So we're looking at pharmaceuticals, we're looking at banks, we're looking at all kinds of issuers here.
What about the risk appetite? If you think about these leverage borrowers looking to re-enter the market, is there demand for it, or are there still worries about losses here, given that default rates are starting to tick higher?
This is exactly the big uncertainty that we're facing in the market, because if you believe that a recession is coming, then obviously you think that there's going to be a massive risk if you buy into these riskier bonds. So the big question is, how do you price the risk of recession when you know that that rates might be peaking? And this is all part of the game. At this point right now, we're seeing that the cost of hedging has been fairly stable. We are within that new normal range, and people are quite comfortable with the fact that there could be some risks, but they've also learned that they cannot forecast too far in advance. So they're buying what they can right now at what they think is a reasonable price for the market right now. And that's as far as they can take it.
Now, really quickly here, Donna, CPI next week, how much can this throw things off course?
I think actually it could potentially be an interesting driver for markets, because if CPI is weaker than expected, then of course that narrative of rates being higher for longer, as well as whether or not there's going to be a rate increase, really starts to play into people's expectations of whether or not borrowing costs are going to fall and whether or not the price is right for these bonds. Again, you know what? It's so hard to know where that CPI number is going to hit. So at this point, that's one of the reasons why you saw all of these issuers hitting the markets now.
Donna Al-Baltaji, we thank you so much for your time. Now, Australian LNG workers at key Chevron sites began partial strikes today after failing to reach an agreement in a dispute that's roiled global gas markets. Joining us now is Bloomberg MLive editor and Eddie Vanderwalt. You have been watching energy markets across the globe all week. What does this mean?
Yeah, this is definitely one to keep an eye on, right? People will remember that last year, European natural gas markets were under real pressure when, you know, there was a disruption to Russian flows. Now, Australian gas usually doesn't make its way all the way to Europe. The Australian gas usually supplies the hub around them, right? It usually goes more to China and to Japan and so on. But this could have knock-on implications later in the winter. European natural gas, at the moment, inventories are very full. We're talking about above 90%. But you need a constant stream of LNG to keep that supplies going, particularly if you have a cold winter. So I think for me, the focus turns to the later contracts, the ones around about February maturity, because I think at later in the winter, we'll see whether we have enough gas. If these strikes are rolling, if they continue, they could really be an issue.
Eddie, at a time when we're focused on gas and, of course, higher oil getting to that $90 a barrel level, kind of reminds us of our continued use of these carbon-heavy energy inputs and then the climate impact. And we're seeing that in Hong Kong today with some remarkable images.
Yeah, absolutely. You know, so we had Hong Kong markets brought to a standstill. They had to be closed because of heavy rainfall. And I think these climate events, as you point out, they're becoming a real focus point for markets. And I think this really brought that home to traders that, you know, okay, so you're not always going to see the New York Stock Exchange or whatever close down as a result of rain, but it's going to impact markets, right? It's going to impact demand. It's going to impact how people trade, and it's going to impact, you know, this kind of flooding that we saw there will impact markets, whether it is commodities like grain or wheat or whatever. You're going to see those impacts, and that's going to impact prices. And I think this is a wake-up call for traders.
Yeah, it's the second Friday in a row that Hong Kong markets have been closed. One was forecast, the typhoon of last Friday. This was not forecast, and it came as a big surprise, of course, for the markets there and people living in that city. Eddie Vanderwalt, thank you very much indeed from the Bloomberg MLive team. Coming up, SoftBank's ARM looking at a 20% sales growth in 2024, boosted by AI. More on that next. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television. People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Shonali Basak in New York.
Now to some of the top stories we're watching this morning. ARM reportedly said on its investor roadshow that it expects revenue growth of more than 20% next year, boosted by demand for chips to power data centers and artificial intelligence. The SoftBank-owned chip designer is looking to raise as much as $4.87 billion in what's supposed to be the largest IPO of the year, but of course, downsized from the initial expectations. Landing ARM's giant IPO is a coup for Mizuho, one of the 4 global investment banks leading this year's biggest deal. Now, the Japanese firm needs to prove that it's just one more thing than a one-time thing. What's fascinating about this, Tom, is not just the coup from Mizuho, of course, such a large bank in Japan, but the global reach that Mizuho is trying to make after buying an investment bank of its own under the leadership of Michal Katz at that corporate investment bank, hiring bankers from across Wall Street.
Right, so third largest bank in Japan, but a coup as they try and make moves and carve out more market share, of course, in the US. And yeah, partly it's about a relationship that goes way back about 40 plus years with Masayoshi Son, but it's also, as you say, about that leader of the US part of that bank, right?
Yeah, and it's very exciting and very interesting because a lot is riding here. Michal Katz is very much involved in the deal itself. From what I know about her and her team, she is often very involved in a lot of the deals, and they have been very much at the forefront of a lot of interesting financings as well. Will be interesting to watch.
Yeah, and we're hearing, of course, Rene Haas with those views in terms of revenues coming through for ARM, about 11% the current fiscal year, looking to 20% by 2024, 2025. With that focus, they want to shift away from smartphones and the arguably vulnerability there to data centers and AI, and the AI component still remains an open question for ARM. Coming up, we're going to speak to Luke Hickmore, talking from ARM to broader tech, investment director at Aberdeen, whether he thinks the tech rally has run out of steam. Stay with us. This is Bloomberg.
with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Surveillance Early Edition, and here is what you need to know. Apple loses nearly $200 billion in market value just days ahead of its next iPhone launch. The high-stakes event risks being overshadowed by multiple controversies in China. The dollar snaps its winning streak as investors focus on dovish comments from Federal Reserve officials, with New York Fed President John Williams telling Bloomberg that policy is in a good place. And Goldman Sachs is said to be moving to fire underperformers as soon as next month, bringing an end to its pandemic freeze on job cuts. I'm Shonali Basak in New York with Tom McKenzie stepping in for Danny Berger in London. Tom, tell us what the markets are doing over in Europe.
Yeah, Shonali, the early optimism, at least modest optimism that came through for European equities after 7 straight days of losses, well, that has evaporated. You're seeing downside of around 0.6% across the European benchmark. So as things stand, we're looking set for 8 straight days of losses for European stocks. That is a stretch that we have not seen for many a year. Euro dollar at 107. Not a lot of movement right now. We continue to focus on that all-important ECB decision, September the 14th, with a Bloomberg survey just showing how split economists are, whether they go for a hike or a hawkish pause. Gas, energy prices, all of that, of course, feeding into the views around inflation longer term. And today, the focus on those supply constraints out of Australia. A strike is now happening there. And of course, those facilities in Australia providing up to about 7% of global LNG supply. That is pushing up prices close to 10%, 9.4% so far in the session. We continue to watch Dutch natural gas. Shonali.
Meanwhile, over here in the United States, we have another day of softness in S&P futures. This has been a tough week for the S&P 500 after a short week here after the Labor Day holiday in New York and the United States. Remember, though, we are watching a bid in bonds. We are watching the 2-year yield hang out at a 4.93 handle. We are watching it cool by about 1 basis point today. This was at about 5% earlier in the week, but we have some critical data coming up in the United States ahead next week, Tom. The Bloomberg U.S. Dollar Index cooling by about 0.1%, a big deal after a meteoric rise this week relative to currencies around the world. And you're watching Brent crude now fall below 90, where it hit earlier in this week. You are watching it down less than 0.1%. But the plateauing of Brent crude is certainly a calm in the market that has been pretty turbulent this week.
Yeah, a little bit of calm, at least in the session so far. And we continue, of course, to listen in to the official commentary coming through from Fed officials. And New York Fed President John Williams says U.S. monetary policy is, in fact, in a good place, but officials will need to pass the data to decide on how to proceed on rates. He spoke to Bloomberg exclusively yesterday.
We'll have to keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again to make sure that we're keeping that steady progress in terms of getting imbalances, shrink imbalances in the labor market and bring inflation back down.
Okay, very pleased to say, bringing in this morning, this Friday, Luke Hickmore, Investment Director at Aberdeen. Luke, do you position for a pause from the Fed?
Yes, for sure, in September, and they'll be delighted to get through September into the October break where we don't get a Fed meeting, and then November we will see, and that's when they will have been passing all of this data, looking at how actually the soft landing narrative is in there, the data has been okay. Few things I think possibly fly in the ointment for a November hike. That labour market data that we've seen recently has just been cooling off. We're seeing some individual company data as well that suggests hiring is also cooling off. Could be interesting. Could be September skip turns into a skip for the rest of the year. At the moment, I think I'm a November hike, but it could easily be no change. This is it. We could be at the plateau.
Could be at the plateau. I see your shoulders rising as you put some caveats around that potential for November to come through. What do you make of the action in the bond markets, Luke, this week? There's been choppiness, to say the least. I guess maybe a consequence of that data dependency versus the forward guidance. Where do you stand on how the yield curve adjusts in the weeks ahead?
What we've seen every time rates have gone up, especially when they've gone up sharply, is that 10-year yield ends up where the base rate is. So, that feels there's a little bit more there to go. But if the market starts really believing, as we do, that you get a long pause in interest rates, the curve will steepen up to get to that level of the 10-year, which for me means, you want to be in the front end of the curve. 5-year and 2-year duration work really well as we get towards this peak or at the peak. We could see those remaining being the best places to be over the next 1 or 2 years, possibly.
Luke, how much does the economic data next week, particularly the inflation print, matter to the narrative of rates? We have seen just such incredible volatility the last couple of weeks. Even this week doesn't mean a lot to see what we see next week.
So the way I've played CPI over the last year is to be just sell duration into every CPI print. Because even when it's been coming down, it's perhaps not been as quickly as people expected, or it's been as broad as we wanted it to be. And you've seen impacts coming through housing in particular. This time, I think probably want to be maybe a little bit long going into the CPI print. I think the continuation of the drop feels the most likely scenario in terms of inflation. But this is not going to be the last of the inflation worries that the market's going to have to face. We are going to get waves of inflation for the next 2 years. Stratigas did a brilliant report on this just a couple of weeks ago. When inflation rises so quick and then comes off, we get waves of it going on. So be long duration now, be at the front end of the curves, be into steepeners, but that vol, I'm afraid, is probably going to be with us for a while.
How significant is the reduction in risk appetite in markets? You saw it reflected in equities this week, but at what point does it also become reflected in the bond market that is facing the brink of fresh issuance?
Yes, and we're seeing a big issuance profile from the corporate side for sure. We know the sovereigns have got a lot to do, whichever country you're talking about in the world, but let's think US, the amount of issuance coming along to cover front-end maturities where they've been borrowing in really short-term markets is huge over the next couple of years. So that's going to be a weigh on the market for sure, but generally you find it's that broader economic picture which will drive your medium-term view rather than your short-term view, rather than supply. And I think that's the thing to keep in mind. We are at or near the top of rates. They will come down, avoid the 10-year, but supply is going to, it'll feed into that volatility that we're going to see anyway.
Luke, do you continue then within that environment to recycle out of equities and into investment grade?
Yes, I think so. And that's not an easy trade either, Tom, is it? It's not like investment grade is super cheap. It's probably fair value. If you look back over the last 20 years, we're fair value. But equities with the NASDAQ in particular, I think Apple's been fascinating the last day or so. But NASDAQ in particular, 1 year and 2 year forward, is trading in the 22, 21 kind of area in terms of PE. That should be in the 15s at this point of the cycle. So it feels rich. It feels set up for a problem to come along, shock the market. Maybe it's about the Fed getting aggressive again, who knows? But it does feel this time of year, seasonality is not your friend in equity markets, especially when pricing is where it is.
Look, on Apple, do you think it marks a turn then in these tech markets, or the tech-focused part of the market? I mean, one way to look at it is short term, at least tactically, this is a great buying opportunity, even if strategically, long term, you're concerned about the exposure that company has to China.
I really struggle with Apple. I'm a anything but Apple consumer. I'm very much in the Google mindset for all of that. But as a company, you may be right, Tom. And, you know, a lot of these tech companies are essentially long duration assets. If we get to the point of being 6 months into a pause for rates and duration starts performing, you should see the tech shares come back too. But they need to change in terms of their PE going forward. That 1 year, 2 year forward numbers are just too rich to get longer again right now. Now, Apple may be the lead towards the rest of the market repricing into a more reasonable valuation metric. And in which case, yes, you could be buying Apple, but I suspect they're not going to go down on their own.
Luke, we'll have to fly to London and steal your BlackBerry. Luke Hickmore of Averaging, thank you so very much for your time. Coming up, now world leaders are gathering in India for this year's G20 summit. We're live in New Delhi next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So see China's growth as slowing over time. That said, China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
US Treasury Secretary Janet Yellen speaking earlier today as global leaders begin to descend on New Delhi. Joining us now is Bloomberg's Menka Doshi in New Delhi. Menka, what is on the agenda then, and what are the implications of Xi Jinping not being on the ground, along with, of course, Vladimir Putin?
Well, as
Secretary Yellen pointed out, China growth is on the agenda, as is food security, supply chain revitalization, the reform of multilateral development banks like the World Bank, climate change and transition finance. I could go on. It's a long list. We're just on the day -1, if I can put it, because the summit officially begins tomorrow. And in the past few hours, we have seen world leaders arrive here in Mumbai. British Prime Minister Rishi Sunak, just moments ago, the Japanese Prime Minister also landing in New Delhi moments ago. And we will see US President Joe Biden getting later this evening. These are some of the issues that these world leaders will discuss and debate over the course of the weekend in the hope of a consensus or agreement that will be represented in a communique. But as you know, and as we've been reporting through the course of this year, the language around the Russia-Ukraine war has been a sticky one this year, which is why we've not yet, in any of the meetings before the Leaders' Summit, produced any communiques. They've only just been leaders' statements, and that seems to be the concern going into the weekend as well. That consensus has been arrived at, on a variety of issues that I listed, but as yet the language on the Russia-Ukraine situation has not been agreed upon, and that might continue to worry the outcome over the weekend.
How are you viewing President Joe Biden's role in the G20, given his communication to allies at this time? How would he define success?
President Biden has said two things in the run-up to this summit. One, that he was disappointed that China President Xi Jinping was not going to make it to the summit. And second, that talks and conversation are very important. And I think that goes to what the U.S. hopes to achieve over the course of the weekend. It will fill some of the space that China has left behind in being able to communicate with members of the global South and bring about agreement on many of these issues. But it will also assert its position on the Russia-Ukraine war emphatically, I'm sure, and that will weigh upon the final communique as I described. So we're waiting to see what the outcome will be. The US President will also be doing a bilateral meeting with the India Prime Minister. That relationship has been going from strength to strength through the course of this year. So again, that's something we're watching closely.
Bloomberg's Menaka Doshi reporting from New Delhi at a critical time. Thank you for your time. Ahead of the G20 summit, let's focus a little more on emerging markets, which will be a key issue at the G20. Joining us now is Ilka Pinar. She's the head of emerging markets fixed income sovereign research at PineBridge Investments. When you think about the week ahead for us, what are you thinking about the role that the developed markets are going to play in relation to the emerging markets, especially at a time with such historic dollar strength?
Yes, so there's definitely a few moving parts in the week ahead, and what we've seen for emerging market debt, especially over the last 2 years, is that market access has become a problem for a lot of the credits, especially the ones that are lower rated, sort of your single B countries. So there they do need global help in the form of IMF and other bilateral partners to step up significantly to help them roll over their debt. So we will be watching the G20 quite closely to see if there will be any other projects such as the DSSI, which can assist those weaker rated EM credits.
Now, how much are the commodity swings a problem when you think about the stability here of many emerging nations when it comes to the very volatile swings you're seeing?
Even though commodity prices have declined from the peak that we had earlier last year, they're still 50% higher than the average we had prior to 2020, say the 3 years before the 2020 downturn. So we do tend to look at that more closely when we look at our raw resource exporters. So even though the year-on-year trend seems to be quite negative, in absolute terms, a lot of the companies on the ground still well supported. And even though, so you mentioned the dollar strengthening quite a bit. Yes, we've seen a about a 2% move since the end of August. But when you look at it on a year-on-year basis, it's still about 6% weaker. And the dollar is really important for EMs because a lot of their debt is priced in dollars. So even though we're monitoring the recent move quite closely, we're still at a juncture where we feel comfortable when we think of it last year this time.
Ilka, what is your level of comfort around the travails of China and how that economy links to the broader EM space?
So China plays a big role. China constitutes about 50% of the EM universe, so it is a big player. However, its impact has been waning over the last number of years. We've been seeing our forecast for the Asia region, excluding China, properly decoupling from the China trajectory. For instance, where we see China growth decelerating for the next 2 years from this year's about 4.9% growth, we see Asia, excluding China, accelerating and having a growth rate that tops China. So even though we cannot ignore China, its impact is definitely less than before.
Ilka, I'm intrigued to kind of get your views on what's happening in Turkey. Erdogan, the president there, has kind of had an about face and is now saying that interest rate hikes are a good thing, having, of course, pursued this very unusual monetary policy over the last few years of cutting interest rates in the face of higher inflation. Is Turkey back to being investable?
So Turkey goes through cycles. So we see this quite often, where they almost have a point of reckoning, and they go back to the orthodox playbook. And then they do tend to throw it out of the window as we near any type of election cycle. And we are getting local elections, I think, in the second quarter of next year again. So we are listening to them closely because we think they might backtrack when we get close to that date. But so far, we are positively surprised. Erdogan, in his comments, when was it, 2 days ago, he did say that interest rate hikes are on the cards, but he also mentioned that he will not do it at the expense of growth. And that is what we all know about monetary policy. You should be willing to bring back control to your interest rate as well as your exchange rate environment at the cost of growth. And it still seems as if he's not willing to do that. But if you look at what the spreads did in Turkey, sitting at around 450 basis points, where we were close to 750 before the elections, it does seem as if it is not necessarily just wolf in sheep's clothing, but maybe this is a turn for the better. But we are still, so if you look on hard currency side, we're a bit positive hard currency side, but local currency, that inflation is going to continue to push higher. And the FX continue to weaken. So we still have a word of caution when it comes to local currency exposure.
Ilka, I'm curious about your thoughts on China a little bit more. I want to harp on the story, given some of the disappointing economic data we've seen. The idea here that the yuan is dropping towards a record low. But what is the ripple effect across emerging markets from the weaknesses we're seeing in China?
So when you talk specifically about the FX link, when the CNY weakens, we have a case where EM currencies strengthen against the CNY. And given that China is also seeing outright deflation in both the PPI as well as CPI, we're seeing that China is exerting a massive disinflationary wave across EM. And that's going to assist EM rate cuts, a rate cutting cycle which we think is going to be vast as well as drawn out. We're going to be in a rate cutting cycle for at least the next 12 to 18 months. On the growth side, however, so our forecast for China is 4.9% this year, down from 5.1%, and then next year 4.5%. So that is a slowing trajectory. And therefore, even though we still, as I mentioned earlier, Asia growth will be able to back that trend. We have lowered our overall emerging market growth forecast to about 3.3% for this year, where when you ask, if you asked me the same question earlier this year, it was sitting at about 3.6, 3.7.
That is Ilka Pinar. We have to leave it there. PineBridge Investments, thank you very much for your time at a pretty critical time here for emerging markets and the Chinese economy. Now coming up, a look at some of the market-moving events to watch throughout the U.S. trading day. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer, Wednesday on Bloomberg.
Happy Friday. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Sonali Basak in New York. Now, a look at what's ahead today. President Biden landing in India for the G20 summit this weekend. We're going to hear from Fed Vice Chair for Supervision, Michael Barr, at 9 a.m. Eastern Time. Then US wholesale inventories, that's 10 a.m. and consumer credit data later today. Sonali.
Yeah, and I want to take a look at some of the stocks we're watching in pre-market trading in the United States, and we have to talk about Apple because that two-day slide of nearly $200 billion on those iPhone curbs to government officials. We did see some cooling pre-market a little earlier. It was reversing its declines, but right now, at the very moment, it's on track for another day of losses, though that the pace of loss is losing some steam. It lost almost 3% yesterday, 3.6% the day before, and so we're seeing a little bit of plateauing ahead of a critical iPhone launch.
It's a question as to whether or not Apple has now become a target for China. It's not clear that it has yet. And we, of course, weigh up the implications of what this ban amongst government agencies and SOE, state-owned enterprises, actually means for this company. But clearly, there's an exposure risk, and we continue to watch how that filters through the NASDAQ after 2 significant days of selling, Sonali.
It's still a long year ahead for Apple, and that does it for us today. Yeah. Surveillance is ahead. We're going to hear from Steve Major of HSBC. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI,
you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Been a pretty impressive cooling of the labor market throughout the course of this year.
We are expecting the inflation numbers to continue to come down.
Part of what's driving our inflation today is lack of labor supply.
I'm not sure that we've seen all the pain that this increase in interest rates will cause to the economy yet.
I believe that the soft landing scenario is the worst case scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Three-day losing streak on the S&P 500, having a little look at day 4. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative here by 0.25% on the S&P 500 in about 3 hours and 25 minutes. President Biden touching down in New Delhi, TK, going into the G20. And right on cue, last week, it was Commerce Secretary Gina Raimondo going over to China, and then we got this new Huawei Mate 60, Tom. Well, I can tell you we've got a Mate 60 Pro Plus out of Huawei. That drops just as the president arrives at the G20 in India.
Somebody on Twitter sent me a video, and it was in a mall somewhere in Asia, and it showed the Huawei store packed, everybody looking at the new toy, and the guy literally turned around across the mall and looked at the Apple store, which is empty. I guess that's sort of the mood right now. Will that mood change at the Apple meeting coming up? But the Huawei thing is Lisa, before we were coming on the show, mentioned, it's complex. It's the product. What's it mean for Apple? The defense characteristics and all that. It's a jumble. It's a toxic brew.
A toxic brew. Ramo, let's talk about that brew. Toxic. 2 days, Apple down more than 6%. Pretty brutal stuff.
Especially when it equals $190 billion of market valuation, just giving you a sense of the scope of what that kind of loss means. Just taking a bigger picture step, we don't understand exactly what the meaning of this pro level is. And I think that we really heard that from the U.S. government saying we have to investigate this further. But two things. Number one, what does this mean for further sanctions, further potential U.S. action if it seems like their current measures aren't working? And two, is this a shift away from China supporting Apple despite the fact that it employs millions of people?
Those are unknowns. I mean, we don't know. I'm going to go with Dan Ives, who's more than enthusiastic. I thought the interview yesterday was Anastasia Amoroso, who just boldly said, stepping in by the dips. I take a huge issue with his media fixation on 200 gazillion with Apple. They're down 8% off $3 trillion. It's what's called a correction. Granted, everybody owns a stock. There's no one breathing. Vetbill has
Vetbill owns Apple.
Vetbill owns Apple, too much of it. He lost his AirPods. But the answer here is it's a correction of a bellwether stock.
Let's work through it with purpose. In about 3 hours, I'll catch up with Dan Ives, by the way, of Wedbush.
Oh, your other property, not on our property.
Next week.
Thank you.
What have we learned in the last 48 hours or so from the Journal, from our reporting here at Bloomberg? That we are starting to see bans at the government level, from state agencies and potentially to state firms. So, Tom, this is the question I've got for you, and maybe you can help me answer it. Do you think there's a big difference between what the Communist Party thinks is good for their government and what the Communist Party thinks is good for their people? Now, the reason I ask that question is not that I think we're going to get a ban from Apple anytime soon, across the whole country. That's not what I'm suggesting. I'm just suggesting we're talking about a communist state who's made the decision that something is not good for employees of their government. Now, Tom, why do you think there's going to be a big difference between what they think is good for their government and what they think is good for their people in a communist country?
I read every word of Mark Gurman published last night. I looked at the time, actually. I believe it was 8:58 p.m. I put it out on Twitter, folks. Mark Gurman, definitive here. And he said exactly what you said, John, and then he alluded to where it becomes not cool. And going back to Mr. Jobs and his aesthetic of Apple, that's the big fear. One day they wake up and the toy's not cool. Right now, I don't think they're there, but that's the Chinese risk.
Totally on the same page. Does the mood sour going into this launch next week? And we'll talk about that from both sides of the argument. Your equity market right now on the S&P 500, negative by 0.2%, just a little bit softer. Yields basically unchanged here, Lisa. 423.83 on the euro. We had a little look at 106 in the last 24 hours against the dollar right now, just about unchanged, Bramo, 107.03.
It's amazing to see that dollar strength today. As you did mention, John, we are going to see President Biden head to New Delhi ahead of that G20 meeting, a bilateral meeting between President Biden and Prime Minister Narendra Modi at 10:05 a.m. Very focused on this relationship, especially and with Apple very much in the forefront. Is there some sort of deal to encourage production to move to India? Today, Fed Speak continues. It includes Fed Vice Chair for Supervision Michael Barr at 9 a.m., San Francisco Fed President Mary Daly at 11 a.m. Really, how do they frame nuance at a time where anything that isn't hawkish is viewed as edifying the idea of cuts and holding and it's supporting rallies in the markets? And today, the economic data, kind of light, includes household change in net worth at 12 noon and consumer credit at 3 p.m. at a time where delinquencies are starting to creep up. And this is what I also am focused on in some of the commentary from retailers. They're starting to see people failing to pay their bills on the margins. When does it become a concern? It still is coming off incredibly low levels. It is nothing like it was even 2 years ago.
That's a great chart on radio. It's just simple, Elisa. Your wonderful chart. We're not back to pre-pandemic delinquencies. I mean, that's the heart of the matter.
You're in a good mood this morning.
I am in a good mood. The kids are back in school.
You've been nice to Lisa.
They're accounted for,
Is that your barometer?
Lisa's in shock.
I'm not sure what to do with this.
It's like, we had a great panel yesterday. Mike Mickey killed it with John Williams.
Yes. Monetary policy's in a good place, I'm told.
It's in a good place.
By the New York
I'm in a
Fed
good
president.
place. John Williams is in a good place.
Okay,
I'm in a good place.
We're all in a good place then. Jonathan Stubbs, equity strategist at Berenberg, joins us right now.
Help us.
Jonathan, forgive me for the soundtrack. Equities are stretched, expensive and narrow. Jonathan, that was you in the last few weeks or so. If you believe they're stretched, expensive and narrow, am I right to guess that you're not buying the first sign of a pullback?
I think you've got to be brave and have very good purpose and reason to do so, and you'd have to back a surge in sort of liquidity around the world, dollar liquidity. I think that's very hard to see, or you'd have to really back a strong recovery in earnings next year. I think there are reasons against that. So, yeah, we think there's more downside risk here as we go through the next few months. We're underweight technology as per your conversation for a number of reasons, not least because the US tech sector is trading above a 60% PE relative to global equities. And when that's happened over the last 30 years, your median return owning US tech is minus 20% relative versus global equities, and your win ratio is just 10%. So the tables look stacked against global equities, US in particular, and tech at this point.
Jonathan, how do you interpret the phrase a correction? It seems to me we've almost forgotten what a correction is, how much a correction is, and how we should behave given a correction. Have we lost our path there?
I think we've lost our path in many ways. We're in a brave new world, as we call it, and there's lots of sort of shifting sands. I mean, pretty much every investment decision has politics, geopolitics involved, just as one element. But yeah, we've always sort of seen a pullback as sort of 5%, maybe a little bit more, a correction, 10, 20%, and beyond that, you're into sort of bear market territory. So these markets could easily be ripe for certainly a pullback, and maybe more than that. As I say, to turn it around and to be really constructive on equities, you need to back a liquidity surge going into next year. That only comes from a macro shock, which is negative first, or you need to back a return to strong earnings. And one issue I have with that is all economists are expecting nominal GDP growth in major economies not to accelerate into next year, but to slow by over 200 basis points. That's the main feed into top line growth. So I think there are earnings headwinds ahead, and therefore liquidity earnings both are not there, in my view, to support this very strong move up. And therefore, I think we have these sort of risks skewing markets sort of moves to the downside as we go through the next sort of quarter or so.
There's a lot to unpack there. I want to just touch on what you mentioned with geopolitics suddenly becoming part of a conversation in a more meaningful way than you've ever seen before. How are you characterizing that in risk models, in quantitative terms?
Yeah, I think it's challenging. You know, we've had a market backdrop for over 40 years, you know, since the early 80s, which has been globalization, and the global economy has been getting closer and closer. The sort of the wonders of just in time, etc. And a variety of forces are changing that, and we appear to have this very sort of this visible invisible conflict between the West and the global South, the expanding BRICS group, and that comes into every investment decision now. It's driving the outperformance of tech this year, for example, because it's forcing the CHIPS Act, you know, your side of the pond. It's driving fiscal policy to underpin growth. It's driving, you know, economist forecasts. It's driving every element of what we think about. How do you sort of hedge that is pretty difficult. But I think, you know, we bring it into our sort of thinking in terms of risk. Right now, we overlay all of our models, and you know, we see quite an attractive, you know, trade and you know, portfolio skew towards energy away from technology, and geopolitics is also part of that, because we're seeing political risk extending, and importantly, energy and tech have broken away from 10-year treasuries over the last 6 months. And if there's some reconnection there, energy gets further support in the months ahead.
There's a tension here as to the why behind energy and the rally that we've seen there. On one hand, it could be tied to global growth, which supports a more supportive backdrop than the one that you just portrayed heading into early next year, certainly for earnings and GDP expansion in developed nations. And then on the other hand, it could be the geopolitics that really caused the rise, and it ends up being disinflationary and suppressive of growth. Which is it that's really fueling your bet on energy?
Well, we bring fundamentals in here as well, because if I'm looking at you know, the 5 biggest European energy names, or some of the US energy names, but the 5 biggest European ones, you know, they're close to net cash, so the balance sheets are, you know, are super solid, and the average free cash flow yield of the 5 biggest is 15%. So these are, you know, these are incredible machines. They just happen to be called energy stocks. So if they get some support from, you know, geopolitical dynamics, shifting sands, oil prices, you know, the macro, they're very well set to perform. They're very cheap. They look cheap against industrials. They look incredibly cheap against tech, historically so in terms of the gaps. And we think at a time where markets are stretched, it's a good place for investors to raise exposure to.
Jonathan Stubbs, the heart of the matter, as you brilliantly said 4 questions ago, is we've got a nominal GDP challenge to the top line. How do you bring that over to the risk to free cash flow? How do you get from reduced nominal GDP over to a free cash flow study for 2025?
Yeah, I think this is critical. I mean, I've been talking about this all year, and it's been one of my sort of handbrakes, if you like, as I've gone through this year. You know, if you look at top line growth, sales growth in the US, 21, 22, both, you know, double digit, maybe even a bit higher post COVID. Europe even more so, and this year you know, top line growth is slowing pretty much to nothing. And analysts are expecting top line growth to accelerate into next year, whereas economists are expecting that top line feed to slow significantly. Just to be clear, you know, in every US recovery, we've seen a 5 percentage point positive delta in nominal growth. As we go into next year, I know it's not a normal cycle, but nominal growth in the US is expected to fall in terms of growth terms by more than 2%. So I think there are challenges here for earnings, there are challenges that read across onto cash flow as well. And that makes it quite tough to look at markets today and to really put significant weight on upside risk as we go into next year. Some industries better positioned for cash than others. Some have better cash flow cushions. But you bring tech back into this. Remember, this is the first time in 15 years where the technology sector does not offer investors a free cash flow premium relative to risk-free, i.e. the free cash flow yield you can get out of the tech sector today is lower than US interest rates. That's the first time we've been there in 15 years. So if you're just taking yield, you take the risk-free, not tech-free cash flow.
Jonathan Stubbs, game changer. Thank you, sir. Jonathan Stubbs there of Berenberg. Just to pick up on Apple, the stock down in the pre-market by just 0.2%. Last couple of days, quite difficult two-day loss of more than 6%. Just got an alert on my iPhone. Software update available tonight. You know what that means? It's like Operation Slowdown, Bramo.
Oh, yeah.
Going into the new release.
I've gotten the same one.
Next week.
Yeah.
You're going to use it?
I always delay it as long as possible because it's
Do
a
they
new
really
interface.
do that?
Well, I don't know if it's exactly
But
tied
that's
to that.
rumored. It's in the zeitgeist. They do that,
There
right?
was actually reported, and I did this because of you, John. You
Thank you,
raised
Bramo.
this, and I was thinking to myself, okay, this is just another thing that's made up. It's a conspiracy. No, it was true. They actually had lawsuits against them in terms of slowing down their operating system. Is it to slow it down? I don't like the whole new interface.
I'm not sure if they are doing it anymore, just for the record.
Probably stopped it.
Yeah, maybe. Shout out to Coco Gov. Can we do that?
Yeah.
US Open finalists.
And they're playing until like 1 a.m. I looked last night, and they're up, like, it goes forever.
I can't believe she's still 19, which is like crazy. We've been talking about it for years.
It's exciting.
Just amazing. Congratulations. Going to be a great weekend for tennis here in New York City. From New York, good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City.
In London, in Sydney,
from Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
So see China's growth as slowing over time. That said, China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
That was Treasury Secretary Janet Yellen speaking in New Delhi as world leaders gather in India for the G20 summit. About 3 hours from now, the president touching down in that nation for the G20 going into the weekend. From New York City this morning, good morning to you all. Pulling back over the last 3 days on the S&P, about to make it day 4. Equity futures on the S&P 500 negative here by a couple of tenths of 1% on the S&P. Apple, where the pain has been, Apple down just a touch. It's negative 0.1%. No real drama there. In the bond market, yields basically unchanged. On a 10-year here, Tom, 4.24. In the FX market, nothing about this dollar is unchanged. 8 consecutive weeks of dollar strength and a euro clinging to 107. 107.01 this
I
morning.
like the clinging nails where we are now, looking across equities, bonds, currencies, commodities. I have no clue what the correlations are right now, but I do take your point, John, that foreign exchange is where I want to look. The fact is, on a boring Friday, it's not, because I got DXY at 105. I mean, just the summed idea with the Torsten Slok and Christina Kampmany and Lee Farage yesterday and our wonderful FX panel here at Bloomberg, this is the heart of the matter. The dollar call is the indicator of all these dynamics we have into Q4.
And there is a split going into the ECB next week, by the way. The team here at Bloomberg putting together the survey. Allow me to share that with you. A Bloomberg survey shows an almost even split between those anticipating a 10th consecutive hike next Thursday and those anticipating a hawkish pause. So, Tom, right down the middle, going into the ECB next Thursday.
We're in a good place. That's
according to New York Fed President John Williams. Yeah, I'm not sure anyone in the ECB can say we're in a good place. Yeah, not quite the same.
In a good place is the President of the United States. There is a symbolism for Air Force One to land in Germany on a refuel to India. He will land there, John, what is it, 9 o'clock hour?
9:25, I'm told, yeah, 9:25 Eastern time.
For a G20 meeting fraught with the geopolitical turmoil of the moment. We are so advantaged in India to have Menaka Doshi with us, with Bloomberg, really experience on the economics, the fabric of India as they greet the elite in New Delhi. Menaka, thank you so much for joining us this morning. What will that meeting be of President Biden with Mr. Modi scheduled for today? What will be, obviously there'll be the smiles and the greeting, but what will be the underlying tension and topic of a Biden-Modi meeting?
Well, I imagine the first thing they'll be talking about is China and China's no-show here in India. And by that, I mean the absence of Chinese President Xi Jinping. They will talk about both the optics of that and the politics of that and how that will impact many of the issues that both leaders are hoping to bring to consensus at this G20 meeting. Let's not forget, Prime Minister Modi had what the Indian government terms as a very successful visit to the U.S. not a long time ago. And this is the fourth visit, I believe, for Treasury Secretary Janet Yellen to India in just this calendar year, and the year isn't over yet. So I suspect the second point that they'll talk about is the strengthening relationship between the two countries, despite the differences that they have, for instance, on the Russia-Ukraine war.
Well, on the war in Ukraine, and the tension point in the West may be India's relationship with Mr. Putin right now. Rumor has it Mr. Putin will not be in attendance. Mr. Xi will not be in attendance. What would you presume will be the way Mr. Biden, or for that matter, Mr. Modi, approach the delicacies of Russia and the war?
India has walked a very fine line, Tom, through the course of the last 2 years as this war is unfolded in wanting to be able to protect its national, geopolitical and commercial interests. So the Indian government has made no bones about wanting to buy oil from Russia at discounted prices, because the high prices we saw in the energy market, which, by the way, have come back over the course of the last few weeks, are debilitating to India that rely on imported crude. So I think the balancing of commercial interests with the geopolitical requirements of the G7 nations who have wanted India to denounce the war in Ukraine, but the government here has refused to use very harsh words and offered instead to mediate between the two warring countries, in a sense will also be a topic of conversation as the two leaders meet this evening. It's delicate, but they've traversed this distance before, and they'll do it again this evening.
How much, Menaka, will the Indian government and business leaders really petition the U.S. to become the #1 producer, taking the place of China? We've seen this with Apple very much in the forefront, and news reports that they are shifting some production to India. How much are Indian leaders going to be active in the recruitment of this?
They're going to be very active, and I suspect this is the one area where there will be no differences between the two sides. Many U.S. corporations are keen to diversify their supply chain, the China +1 strategy as it's called, and India is very keen to benefit from that. You cited the Apple example, and I think both governments are working to see if there are other such opportunities that the U.S. corporations and the Indian government can avail of. Let's not forget this G20 summit is a precursor of sort for Prime Minister Modi, who will seek re-election next year for the third time, and he hopes to win. And so he wants to come out of this summit looking strong, not just from the point of view of bringing all these global leaders together, but bagging some key decisions that benefit the economy. This is the world's most populous country, growing at the fastest rate of any large economy, but we need jobs. And for that, we need manufacturing. And I suspect Prime Minister Modi hopes to end this summit with some key announcements to that effect.
Monica, thank you. Going into the G20 with an absent President Xi Jinping on some of the tension between India and China. Let's throw Apple into that conversation as well. This came from Citi a little bit earlier this morning, still constructive on the stock. This quote right here, TK. China is about 20% of total iPhones. However, India, with 1.5 billion population and around 5% middle class, is the bigger incremental opportunity for Apple in our view. How quickly the bullish thesis changes. That's from Citi, Tom, on India and on this Apple stock.
It's been there for my lifetime. I mean, I'm going to take it back to John Kenneth Galbraith as ambassador for John F. Kennedy, which was in my youth, very much younger. And it's not that it's been an enigma, but it's like, okay, when are we going? I read McKinsey reports that say, okay, what's the catalyst? When are we going? And maybe the catalyst for in India that people have hoped for is not from India, but for China messing it up, which maybe we're seeing right now.
Well, just on the latest on China as well, and on the new Huawei phone, this is what the team over at Citi had to say about that. They believe the Mate 60's technology is still 2 or 3 years behind iPhone with limited production capacity. So there's 2 points there that I think are really important.
Yeah.
One is the tech, and 2 is the production capacity,
Totally
Tom.
agree. Yeah.
Can they meet the demand in China to really rival what Apple might produce over there with the unveiling of the new iPhone in about a week's time?
The labor component is critical, and frankly, I think it's critical for the hope of American manufacturing as well. We've got all these dreams of rekindling manufacturing here, but do we have the labor component down to get that done?
What this does to me is it says maybe China is not there yet. But to both of your points earlier, there is a major sentiment shift. It's been 6 months since Tim Cook came out and said that he has a symbiotic relationship with China. It's not looking so symbiotic right now. It's looking very different. There has been a tone shift. So is this basically the warning shot until China gets the technology to actually compete with Apple? Hey, Apple, maybe move more of your production elsewhere and try to really tap into the growth areas in other places.
Or is an 8, 9, 10% correction here, on my chart, perfectly down to the long-term moving average of Apple? Is it the mother of all corrections and opportunity into, say, the next 2 or 3 years, if you believe that they're going to do something September 12th, like sell me more iPhones?
They're going to send you more iPhones.
I'm listening to Ives and Anastasia Amoroso, and I'm saying, okay, what am I missing? There's all this hysteria out there. I get it.
Sure.
It may be done. It may be over. But how many times have I heard this?
Many times.
With Apple, like uncountable
I would ask
times.
this, though. We mentioned the diplomat, Tim Cook. He's been phenomenal at navigating the tension between the US and China without getting into too much trouble. If Apple's at the crosshairs of this now, what about everybody else, TK? If Apple's finding themselves in trouble and Tim Cook has done a phenomenal job of navigating this, what about everybody else?
My single determinant to China, and I may be wrong on this, I'm speaking as an amateur, is foreign direct investment into China. That's the thermometer, the barometer for me.
One of our favorites up next, Steve Major of HSBC from New York City. This is Bloomberg.
the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I think we're attempting to break the heat wave in New York City today. Is that breaking later, Tom?
Yeah, last
Into
day.
Tomorrow?
Yeah, huge
Okay,
thunderstorms north of New York last night. Really spectacular. But yeah, I think we break it today.
So sticky.
Yeah.
Humidity in September, yeah. We'd call that summer, you know, TK.
Yeah, Rob Carolyn said it's not that unusual, but it's just the weight of it off of a horrific summer in America for heat, like in Europe.
Yeah, there's your weather check. Equities look like this on the S&P 500. Doesn't get much better than that.
We do it
We're
in Celsius.
on the S&P. We're down here by about 0.1%, down 0.2% on the NASDAQ. Tough few days for the S&P 500. Three-day loss, about to become 4, if this is anything to go by on the S&P over that period. Down not even 1.5%. So, Tom, we'll drain the drama from that conversation just for now, but Apple is where the pain has been. That stock in 2 days down more than 6%.
Mark Gurman Publishing, I put that out on Twitter, definitive on Apple. That's a good summary for everybody waking up this morning.
Let's turn to the bond market, Tom. 2-year, 10-year, 30-year. 10-year right now, 4.24.23. Yields basically unchanged. Have to say, some real conflict in the data. Claims back to the lowest levels we've seen going back to February. Much better ISM. And then you look at the anecdotal stuff, you look at the beige book, and it just screams slowdown. Soft patch coming for the US. A question we've asked in the last week or so, how much weight should you put on each data point at the moment? So that's bonds, 10-year 4.24, TK 2-year 4.94.
We're in a good place.
We're in a good place. According to John Williams,
we're in a good place.
We're in a good place.
He said we're restrictive, though. I thought that was interesting. I mean, he's like Dominic Constantine saying we're there.
Quiet period kicks off tomorrow. No more Fed speak.
Oh, really?
Yeah.
Joy to the world.
So all of this Fed speak is going into the quiet period before the Federal Reserve decision on the 20th. I want to finish with foreign exchange. 8 consecutive weeks of dollar strength. Just phenomenal. The euro holding on to 107. 107.01. Just about positive here, Tom, by 0.05%.
It makes Lisa's trips, you know, it's good. She's got a strong dollar. She travels around the world.
Where's Bramo going next?
I don't know.
Yeah, you tell me.
She's working longitudinally west.
Europe in September's usually nice, Lisa. A little bit cooler.
Not a,
Sun's less severe.
All right, thank you. I'm going to
Mediterranean,
London. I'm going to London in a couple of weeks.
We're all going to London in a couple of weeks.
That's true.
That will feel like fall. We're going to come from like 30-something here in New York down to 16, 17 if you're lucky in
No
London.
one in American TV does Celsius like John Farrow.
What would you like it in? Fahrenheit?
Well, we do Fahrenheit, that's
okay,
fine.
yeah,
So
unique.
We drive on the right side of the road.
Okay, so from 90s down to like...
Nailed it.
60s.
Yeah.
Does that help?
What do we got under surveillance?
Under surveillance this morning, TK. If you don't interrupt, I'll get there. China, US tensions building into the G20 meetings. The US saying it's begun its official probe into the chip used in Huawei's Mate 60 Pro as the China tech company debuts an even more powerful phone, the Mate 60 Pro Plus. Tom, I'm not sure if this is to coincide with the G20 or to coincide with the unveiling of the new iPhone next week, but the timing of this stuff has been pretty phenomenal.
Are they a government company? I mean, I guess, are they a state-owned enterprise? I don't know. I mean, I get the angst. I mean, we had a balloon flying over America, but what's the linkage from this cell phone, Huawei, over to our fears about a balloon over Montana.
It does two things, actually, and it raises some questions for President Biden. Are his sanctions, are some of the restrictions on chip exports working? Are they doing anything? Is this going to foster a harder line in Washington? And what does this do heading into the election for him on that front? That's number one. And so it really presents an awkward scene for him. But then on the Apple front, what they want to do is say, hey, we can compete. And oh, yeah, hey, population, who is the audience of this? Is it the U.S. or is this a domestic audience to rally the troops and say, let's get behind this new China-made phone?
Apple in the pre-market just about positive by 0.1%. Let's talk about fragile energy markets. Gas prices rising as workers at Chevron's Australian LNG plants begin striking today. The impacted operations accounted for 7% of global LNG supply last year. And Tom, this is sparking a move in European gas prices every time we get a headline around this story.
We're learning about it. I've been doing LNG seminars for, 40 years? It was going to be the savior 30, 40 years ago, it seems like, and now LNG's dominant. And, we're learning about the geopolitics of this and maybe even the one price of LNG. It's sort of like a Brent crude thing, but we don't follow it.
I promised the end of the weather check, but I've got a little bit more weather for you. Hong Kong shutting down and cancelling trading today as the city is hit with its heaviest rainstorm on record. The pictures out of Hong Kong just absolutely
139 years.
Phenomenal. And here in New York City, we're hoping that we don't see scenes like this as Hurricane Lee strengthens to a Category 5 storm in the Caribbean. Lisa, the storm could hit New York and Boston as soon as next week.
We were looking at last night at some of these images at home, and I said, these look like some of the Armageddon pictures of climate change and what happens to New York and other cities. You know what I'm saying? If you look at some of those movies, that's what it looks like when you see rivers going past, the second floor of buildings in Hong Kong.
Under surveillance bonus. Let's get to it right now before we get to Stephen Major. Bonus round under surveillance. Steve Major demanded that we look. Do you know there's no Premier League football this weekend?
I'm aware of that.
What are we going to do? Let's consider North Macedonia, Italy.
Let's not.
Again, we're going to do it.
Who sanctioned this in the control room?
Alexander Trzachovsky. This is Northern Macedonia scoring late a few years ago. Mr. Trzachovsky scoring here as well. How will Italy proceed today?
New coach.
Tomorrow.
New coach, Spalletti. He won the title with Napoli in Serie A.
They got to be fired up
last year. I hope,
completely
I feel like cursing. I hope they're fired up because that was dreadful. That was dreadful.
It was a real low.
When have we done bonus round? That's not a bonus round.
Steve Major, it's the only reason we booked Steve Major.
Bonus round, I just feel like I'm being trolled.
Steve Major, you're going to bring Major in here. He's living large. West Ham is having a season all season because the guy went from Richmond over there to coach. And the answer is, I got to watch North Macedonia, Italy, rooting for Italy tomorrow.
I'm not going to be watching that. I'm pleased to say that my good friend on my side, Steve Major, joins us right now, Global Head of Fixed Income Research at HSBC. Steve, wonderful to catch up with you, sir. We're going to park the football. We're going to talk about this bond market. You are bullish. What do you think the Bears, Steve, have got wrong about the outlook for this bond market in America?
Well, where to start? I think that the list is getting longer and longer. When I look at valuations, absolute and relative valuations, treasuries just stand out. We completed our monthly asset allocation this week, and most of my colleagues have reined in their enthusiasm on other bond markets because it's not attractive. I mean, I'm struggling to find a single EM rates market that I'd want to buy right now. Much of the total returns come through FX anyway. Credit is tight. Treasuries are standing out versus equities. But at some stage, people are going to start moving from bills into bonds because they're going to start thinking about the opportunity cost. I'll tell you that I think that yields today, 10-year yields are 100 basis points higher than they were in the early summer, but they're the same level as they were in October 22. And since then, the Fed's hiked by 225 basis points. So something's going on to contain that 10-year yield. And I think it's difficult to see it going much higher. So I look at it and think it's asymmetric. Maybe nothing much happens. We go sideways for a bit. But when the yields move, they're going to move down and a lot.
Stephen, you at HSBC are hardwired into the China slowdown, the knowledge of China, the dynamic of their GDP. If we do get some form of new, diminished Chinese economic growth, is that a disinflationary impulse that assists in driving yields lower, fixed income prices up?
Well, quite possibly, yes. It's not good for many markets. I mean, the EM tends to quite like a soft dollar and a strong China. It's got the opposite right now. So the channels through which China might matter to global fixed income are many. It could be through capital flows, it could be through trade and therefore GDP, it could be through FX, it could be through some form of contagion, some kind of financial stability incident. I mean, there's so many. The list is long, and it seems that already there's some influence. But what kind of policymaker is ever going to say what's really happening? We're going to find out afterwards. So I think that already you've got a big gap between the yield levels offered by China and many other markets compared to the US. And that's the thing I'm focusing on at the moment. It's very difficult to determine exactly what the channel and the process is going to be, but I think it matters.
How do you understand, Steve, why we haven't seen yields go lower this year? Why they've stayed so sticky and persistently so, with economic data surprising to the upside?
That we've just completed the most aggressive tightening phase in 4 decades. It looks like the momentum of the tightening is definitely fading, and I think that we're entering a very important period here where there's probably going to be a handoff from the focus on inflation onto the real economy data, and it's going to be a slow process. But I think that I'll repeat what I just said. Yields probably go sideways for now, but when they make the next big move, it's very unlikely to be up. The next big move is more likely to be down, and therefore you're better to be long.
Are you saying that the risk right now is for some sort of systemic event and that you see one on the horizon versus the upside growth surprises that we have been seeing, which has led a lot of people to say that really the asymmetry goes to the other side, that growth could actually reignite? And I've heard that's even from Fed officials themselves.
So the GDP now is a notoriously volatile series. It's been goosed up by the fiscal loosening. And the trend GDP is still, 175, 180. The smart people, I believe, recognize that the R-star is unchanged from before the pandemic. So the policy rate is more than double what the equilibrium rate is going to be. So it says to me that we are at or very close to the peak in the cycle.
So given that, Steve, how do you place a bet here out a year or two? Are you, on a retail basis, are you laddered? Do you barbell? What's the major strategy to go price up, yield down?
Yeah, that's now the key question. I've got much more comfortable with just outright long of 10-year plus, rather than trying to play anything fancy with the curve. If you start buying 2s versus 10s and play a steepener, you've got too much carry to overcome. And so the strategy favors taking duration over yield curve exposure right now.
I can't say enough, John, how important that is to see a bullet approach from a major bank. You don't see that nowadays. Everybody wants to do ballet, fancy CFA garbage, and major just says shut up and buy it.
We're talking about treasuries here, Steve. Let's talk about that trade relative to what you expect to happen in the UK, in Europe. Is it a similar story, Steve, or is it different?
Well, the UK might be leading things today, at least. It happens occasionally, doesn't it? I think for every 100 days, maybe there's 5 to 10 days when the UK and the Eurozone can pull the US around. And today might have been one of those. The front end of the UK got some life into it. It seems like the UK could be at the peak. The data's supporting that. So it's all connected. I just think that at the moment, the relative value between treasuries and bunds and gilts and Aussie, Canada, it favors treasuries. Just run a spread series of the markets. And that's what's struck me, is that it's a relative argument, not just an absolute one.
Steve, final question. Top 4, West Ham. What does James Ward-Prowse have to do to get a call-up for the national team?
Hasn't he been great? What a joy. Surely he must be on the list, but it's been a joy to watch.
Just snubs by Southgate can continuously.
I don't get it.
TK.
I read the press on this, Henry Winder and all that, and you guys are vicious over there. I mean, we don't have this discussion.
Oh, it's pretty brutal stuff,
brutal stuff,
no, the tabloids.
Nasty.
The sports pages. Steve, thank you, sir, for the update on the bond market and a sneak peek of some of the football chat as well over in England. Steve Major of HSBC. The asymmetric story around the 10-year bond and why he thinks yields are going to fall and this Treasury market is going to rally.
Yeah, I can't say enough about a guy like that at a major bank just saying, shut up and buy the point. Buy the actual indicated 10-year. If you want to get braver, go out farther. Point versus a lot of, spread talk and laddered and barbell.
Well, he said something in there that was really important, and he said that the smart people see R-star going back to what it used to be.
Yes.
And there is actually a huge disagreement on that, and I'm curious to hear, where the smart people shake out on that ultimately.
Steve Major's in a good place.
He's in a good place too. He sounded happy, didn't he?
He sounded happy.
Just got a note from Deutsche Bank on the ECB going into next week. They call it an uncertain pause. They say there's a real possibility of further hikes and later cuts. That's the ECB.
It's a pause.
Different chat
hawk
to the Federal Reserve. Pauses hawk.
No, you can't even say it. I can't even say it.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
What I'm grateful to say is that we've seen inflation come down. I feel like we're in restrictive space now, and now that we just need to let that restriction play out and let it bring inflation, continue to bring inflation down to get back into the range of our target. And if we can do that, that would be a good thing.
Sounds like patience from the Atlanta Fed President Raphael Bostic, just echoing what we heard from the New York Fed President John Williams speaking to Mike McKee. Looks like, TK, rate hikes are on ice. Going into the Federal Reserve meeting 2 weeks from now and going into the quiet period for the Federal Reserve starting this weekend.
Well, it's going to have to see, what's out there. We're in a good place, which is important. Bostic says that. Williams says that. That's going to be the mantra.
Goolsby said something similar.
The good place for us is, did you say quiet period starts tomorrow?
Yeah, no more Fed speak.
That's very good. Let's look at the Bostic GDP statistic now. It's a percent number, but we'll look at it to 3 digits, 5.576%.
We're calling it Bostic GDP now.
It's a Bostic GDP now.
Okay.
Statistic. He's, of course, running the shop at Atlanta. I don't know what to make of the number. I get it. People lecture me. It's the snapshot of GDP right now. Lisa, what do you think? 3/4 of the nation is like, really?
Well, even Atlanta GDP, the people who capture this data say that it doesn't account for certain factors that are going to probably bring it significantly down. That said, and I was actually just speaking with a number of people who are doing this on-the-ground research, if you look at the qualitative data, it is actually painting a similar picture as the quantitative data, which is that things are slowing but not breaking. And what do you do with that? As a policymaker, how do you nuance a message at a time where there isn't a clear angle to take. There's not a clear risk that's the preeminent one.
Have you been speaking to people that conduct the UMich survey? Is that what you've been doing?
That
what have you been up to?
Every night. No, I was speaking to some people who are, you know,
these your friends
close
again?
to the Fed.
Okay.
What you think that my friends
No,
are?
just trying to work out who the source is.
You want her home in her pajamas, and she's out
Who are some
partying
people?
with Fed
Just trying to
officials.
work out who Bramo's been hanging out with in New York.
Last call down in Soho.
Was this at the US Open? Fashion Week in Soho?
No, I
Fashion Week in
definitely was
Soho?
not in Fashion Week in Soho. Were you?
I was not at Fashion Week in Soho. Why are you asking? Why's the camera sitting on me? I wasn't there. I might have been there, but not for Fashion Week.
Not for Fashion Week.
Can we move on? Probably move on.
Let's move on now.
Talk
We're
about
gonna
crude.
move
That's a
on
good
with-
comeback. Nice.
Brent crude, $90.43. That's something that has changed this week. We need a brief here on the Marshallian cross of supply and demand in oil. Emery Sen is expert on this, Director of Research at Energy Aspects. Emery, you've nailed this. How tenuous is the path from $90 Brent to $100 Brent?
I would say mostly stable from here. Famous last words. I don't mean like there won't be any volatility, but I do think the big move up has happened. You know, we've been calling for $91 Brent in Q4, so we are pretty much there, a bit sooner than expected, but pretty much there. Look, could we touch $100? Of course we can. Are we expecting prices to average above $100 just yet without an outage? No. I think what we are probably going to see is, again, what you guys were discussing earlier, things are slowing in the economy, but oil demand is still very, very strong, don't get me wrong. And Saudi Arabia will keep supplies in check to ensure that inventories continue to draw. That's where we are right now.
Am I correct that the move 75-ish up to 90, demand is not diminished? I mean, the elasticity of demand here on the price movement doesn't seem to be evident. Demand just continues, right?
Absolutely. I mean, $90, I really don't think there is any change versus 75. I've always been saying that you don't really get a change till it's about $120, right? And then, but having said that, Tom, I will highlight that even though crude has moved from $75 to $90, what has moved in some ways the opposite direction are diesel and gasoline cracks. Even when Brent was at 80, you had gasoline and diesel cracks at 30 and 40. So what you and I were paying at the pump, sometimes even higher if you're based in Europe because of taxes, was say $120 to $130 per barrel. Now those product cracks are coming off a bit and crude has gone up. So it's a redistribution. But the point still stands. Below 120, you don't really see an impact on demand.
Amrita, how much are we seeing growth drive this? The idea that the U.S. has outperformed, travel spending still seems to be robust. How much is that underpinning this more than just the output cuts that we've been talking about from Saudi Arabia?
Oh, I think demand is huge. Like, look, we started the year talking about or forecasting 1.3 million barrels per day of year-on-year growth. I've highlighted even to you guys that, look, we know we were on the low end, but I thought we'd come in more like 1.6, maybe 1.7. We're tracking 2 million barrels per day right now. First half of the year, we have full data for, and Tom's going to love this, demand has come in 500,000 barrels per day higher than we expected. And refineries have come in, runs have come in 500,000 barrels per day lower than we expected because they can't get hold of alternatives once they've lost Russian crude and feedstock in Europe and the US. So this has been a real struggle for refineries to meet the demand, but demand has absolutely outperformed. This has been a products-led rally in crude. When crude started rallying a couple of weeks or a couple of months ago now, it was products that led it. So it has had to be a demand-side story.
So in other words, are you saying that there's a floor for how much prices can go down, even if there is some sort of increase in production on the margins, and even if there is a bit of a slowdown just simply because of the roadblock that is refining?
Absolutely. The fact that refining is tight and margins are tight and product stocks are super low, that just means refining margins, while they will ease from current like crazy high levels, it started to ease already, will remain higher for longer, which provides a much more solid floor for oil prices. And I think also why, you know, Prince Abdulaziz, generally Saudi Arabia, they are in a comfortable place. You know, very much he described to me as the situation is if you go in for a long bath on a Sunday, relaxed bubble bath, he called it, that's the kind of position he's in. He wants to make sure the market doesn't have too much volatility, it's stable, and he wants to keep that going.
Amrita, maybe off your remit a little bit, but Bloomberg has done wonderful work in the last number of days on the rebuild of coal usage in China. Has ESG taken a step back from the lens of Amrita Sen and energy aspects? Has ESG like reverted or retreated over the last number of months?
I wouldn't say reverted, retreated, yes. I'm in Asia right now. I'm in Singapore. I was in Beijing last week. I think ESG features, but features a lot less than it used to. Even in Europe, ever since the Russian invasion in Ukraine, when people have to pay up for energy, I think a lot of realism kicks in. And I think that's definitely what's happening. Look, ESG will remain here. It's not going to go away, and rightly so. We should absolutely endeavor, and all companies are pushing towards a greener future. But I think there is a bit more realism now that you can't just move away from fossil fuels overall, and the path needs to kind of incorporate both.
I mean, to me, the arch question here, and JP Morgan, I think, did some great work on this, folks. We will speak with Christian Malik in London here in about 8 days, is a basic idea that EM, third world, whatever you want to call it, they're insatiable and demand just is not going to budge. Is that the case?
I think that's been our view, that, look, non-OECD demand will continue to rise because ultimately, and I think the Nigerian minister put it very well, saying we too are transitioning, but away from cow dung and wood to oil and gas. Remember, for a lot of these countries, electricity isn't even a given. And I think that's what they are focusing on right now. Everybody wants to grow. Everybody wants to get wealthier and fly and drive around. So we tend to look at energy transition from a very Western lens. It's very easy for Americans and Europeans to sit and talk about energy transition when the rest of the world is just starting to grow and have very similar aspirations of wealth and growth.
Too true. Amrita, thank you. Amrita Sen there of Energy Aspects. Thank you for the update. There's something amiss here, isn't there? How do you reconcile this story of a global growth slowdown with what you're seeing in the commodity market, both in crude and iron ore as well? If it was just crude, I'd say this is a supply story, but it's not just crude. It's iron ore at multi-month highs, Tom.
Totally agree. I looked at the Bloomberg Commodity Index. One of the first things I did this in this fractured week here with the, vacations in school and all that. And the fact is you're absolutely dead on, and I wonder what it means for China GDP. And this debate, Lisa, you've been great on this. Is it a domestic turmoil in China versus a more econo-babble global China, which gets you to gloom of 2% GDP? I'm not there.
Leland Miller of China Beige Book was great on this. And he said, people are getting way over their skis in terms of how terrible things are in China. China isn't going to grow the way that it has in the past. But it's not exactly, collapsing. There still is a lot of demand. And that's really playing out. It plays to the iron domestic, but it plays to the iron ore a little bit more.
Crude this morning, Brent crude up by 0.5%, $90 a barrel. Just around those levels. WTI, $87. Do we know if ESPN and Walt Disney have sorted out that stuff respectively?
They haven't, but we do know ESPN Plus, it's critical tomorrow, 3:45 p.m., North Macedonia, Italy.
Do you have ESPN Plus?
No, but I think I have to subscribe just to see Italy win.
I've got ESPN Plus.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will